Estimating the Fed's capacity to tighten.
Inflation will start to decrease a little bit on that year-over-year number.
You're going to see potential for a real divergence in monetary policy.
The early part of the cycle where we see the rapid growth is behind us.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Will 69 become 70? From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Katie Lyons and Matt Miller. I'm Jonathan Ferro. Your equity market higher by 13, up by a third of 1%. Another all-time high. Kaylee at the close yesterday.
Yep, 69 of them this year, John. Will we make it 70 today? It looks like it, judging by futures trading. And what strikes me, John, is we're dancing around the 4,800 level now. In January of this year, when we were looking ahead and what would come in the next 12 months, the average strategist target was 4,100. How far we have come and how far above where we thought we would be.
47.91 at the close yesterday. Do you know what the high estimate was going back 12 months? It was Goldman at 4,400. That was the high, Katie. And do you remember at the time people turned around and said 4,400, that's ridiculous.
Yeah.
We're still, what were we, 35, 3,600, 37, something like that. 44 felt like it was way out there. Do you think there's a similar attitude towards the forecast coming for next year for 12 months out? Well,
it's interesting. Obviously, there is a wide divergence in the forecast. Morgan Stanley and Mike Wilson, the team, there still thinks we're going lower next year, some out beyond 55,000 and above. What's interesting, though, is that I was talking to Eddie Vanderwald about this earlier. He said that there was so much more uncertainty in 2020 and going into 2021, and a lot of that has cleared up 21 into 22. So maybe we actually have a better understanding of at least what's ahead of us, although that hasn't formed into any kind of consensus as to how far the equity market's going to run up in the next 12 months.
I think that over the last 24 hours, Matt Miller, we've taken a very small baby step towards normalcy. The CDC turning around and saying you don't have to isolate for 10 days, you have to isolate for 5. Isn't that a very small step to treating this like your regular seasonal virus?
Yeah, absolutely. I mean, still recommending that you wait until you're symptom-free and that you continue to wear masks for another 5 days after, but it definitely allows employees to get back to work maybe on flights or maybe in banks or maybe at Apple stores if they're open at a much faster rate. So maybe we get closer and closer to, remember when Bill Gates forecast this would become like the flu in 2022? We're definitely getting closer to that.
There's a hope that's the case. Goldman Sachs, though, Kelly Lyons saying if you want to come back to the office in February, get boosted. That's the new mandate.
Yeah, if you're eligible to get boosted by February 1st, that's what you have to do. Also, Goldman testing twice a week. But the point of the story there is they're bringing people back to the office, unlike other banks like Wells Fargo that have indefinitely postponed that return. Goldman, who was really out of the gate up front on that, saying people are coming back. They're sticking to it just with tighter restrictions.
Get back to the office in September. Get back to the office becomes February, and let's hope that's not the case in February, that we're talking about March, April, and so on. In your equity market, to whip through things for you this Tuesday morning, good morning to you all. A lift in this stock market once again, up 0.25% on the S&P 500. On the NASDAQ 100, we can talk about the big tech players a little bit later, up 82 on the NASDAQ 100, advancing 0.5%. Yields at about 147 on 10s. They come in about 0.5 basis points. Katie, your bond market, not doing much at all.
Yeah, not going much of anywhere at 147. Also not where we thought we would be at the end of this year. We were talking more like 2% 12 months ago. I wonder where we will be 12 months from now. Of course, we'll also talk all things equities with Ed Yardeni of Yardeni Research coming up at 7 a.m. Eastern time. He sees us going out to 5,200 end of 2022. So where does that 400 points of upside come from? And why are those like Mike Wilson at Morgan Stanley wrong on that idea? We'll also continue that conversation with Patrick Armstrong of Plurimu Wealth. He's interested in buying into volatility here. And then talk all things Fed with John Riding, an economist over at Breen Capital. It's not just about where monetary policy goes next year, John. It is who is going to sit in the still vacant seats. We do not yet have the picks from the Biden administration. And speaking of political considerations, geopolitical situations, we'll have all things covered on oil with Ellen Wald of the Atlantic Council.
I'm looking forward to catching up with Wendy Schiller as well in about 10 minutes' time. And Matt Miller, the president in the last 24 hours, turning around and saying there is no federal solution. And as you might anticipate, taking some real heat from conservatives for those remarks.
Yeah, I saw that headline. We were live on air yesterday when he was speaking, listened to it in on him for a while. And It's interesting, you made the important point, I think, John, yesterday, that there haven't been any governments that have nailed this on a federal level or even at a more local level. The UK has, of course, had its issues. Germany has had its issues. Of course, the periphery of Europe was inflamed with COVID cases at the start and is now climbing back up there. So in terms of a federal solution, maybe it's something that critics think you ought to strive for, but it doesn't look like anyone has found one yet.
And I think the president acknowledging there's some work to do as well on testing. Hopefully, we get some improvement on that pretty quickly. We need to talk about this bond market too, going into a really important first quarter for the Federal Reserve. Jim Caron joins us now, fixed income portfolio manager at Morgan Stanley Investment Management. Jim, you've picked up on something that I think has been missed as well. This big pivot from the Federal Reserve is unanimous. Jim, how important is that?
Yeah, hey, thank you all for having me on the show. I do think it's quite important because when was the last time the Fed was unanimous? And it was basically when there was more of a pandemic crisis going through. Now they're unanimous in the sense that they're going to hike interest rates, and they have almost what seems like a preset path to try to hike rates about 200 basis points by 2024. And what that does is it reduces volatility and it provides certainty, because what matters in interest rates and for bond investors is a pace and path of rate moves, in this case higher. What that allows you to do is predict your cost of capital going into the future if you're an equity investor or if you're a business owner or something of that nature. And effectively, this is something that I think lowers some of the volatility, at least of the interest rate part of the equation going forward. And the most important thing about being unanimous is that there are no hawks lurking in dark, shadowy corners that are going to jump out and surprise the market and become more hawkish unless the data really, really shows that. So this is something that I think is going to be very helpful for the markets going forward, and we'll have to see how this all unfolds in the months ahead.
Well, and Jim, as we know, it's not just about when the Fed lifts off. It's about what the hiking cycle is actually going to look like and how high that rate ultimately goes. Do you think the market has a proper understanding of what the terminal rate actually will be?
It's a great question. The answer is no. The market really doesn't. I know it's priced by the market, and there's a lot of inconsistency, right? So one of the things that people look at are these five-year forward overnight index swaps, and this is a market pricing of the Fed funds rate, and that says 1.5%. The Fed is saying that their terminal value is 2.5%, meaning that that's when the Fed's going to end hiking interest rates in this cycle. There's about a 100 basis point disconnect based on what the market pricing is versus what the Fed is actually saying. Now, what I also think is very, very important is that even in their own projections, they're saying that by 2024 that the Fed funds rate will go to 2.18%, which is exactly where core PCE will be. So that means if we look at the nominal Fed funds rate at 2.18% and inflation at 2.18%, then that means the real Fed funds rate will be zero or neutral. So even though the Fed is increasing interest rates right now, they're not tightening, they're just moving towards neutral. And that's something else that's also showing a lot of accommodation for markets even still. So for people clamoring for a tightening right now, they're not really getting that. They may get that, though, and this is the important point, in the form of tapering and potentially balance sheet runoff. But the balance sheet is going to continue to grow until $9 trillion at the Fed until the end of March or somewhere around that time, and then it's got to start to come down from there. I think that's the bigger issue going forward.
Jim, you focus obviously on fixed income as head of global macro strategies on the global fixed income team, and clearly monetary policy incredibly important there as it is on the equities side, but not as important everywhere as the fiscal has been. What do you think about the gridlock that we're seeing? I guess you could call it gridlock in Washington, the lack of a Build Back Better passage, and kind of the pessimism there.
So I think this is somewhat being misread by the markets. Now, one of the things that gets criticized is that without the passage of Build Back Better, that GDP will be lower, and many people have taken down their forecasts. That's just math. That's because government spending is part of GDP. So think about it in other ways. If the government just spent a lot of money and went into deficit, the GDP could potentially go higher because you have more government spending. Eventually, this all gets normalized, meaning that you end up getting higher levels of expected inflation. So that means your quality of growth, your real growth, your nominal growth minus inflation or minus inflation expectations with a smaller fiscal package that might have a bigger fiscal multiplier might actually do better. So effectively, the fact that we may get a lower amount of GDP, but you get higher quality GDP due to some of this gridlock in Washington means that you get higher quality profit margins and higher quality earnings going forward. And I don't think this is being missed by the equity markets. I don't think this is being missed by credit markets, because it also means that default risk can stay relatively low as well. So I think there's a confluence of information that's out there, and I think it's very complex, and I think we have to really look through it. It's not just about Build Back Better and creating higher fiscal spending that generates higher GDP, because what we also have to note is that the CBO studies show that this is really a $3.5 trillion spend, and the Penn Wharton studies would show that it's actually a $4.5 trillion spend, which is really, really big deficit spending, and markets tend not to like that over time.
Hey, Jim, wonderful to catch up with you. Is it too late to say Merry Christmas on the 28th? Can we do that still?
Merry Christmas.
Merry Christmas, Jim. It's good to see you, buddy. Jim Karen on the bond market and a whole lot more. Matt Miller, moving forward from here, I thought it was the least surprising surprise that we've had from Washington, D.C. all year, that this broke apart and Senator Manchin was at the epicenter of it. I was away at the time when this the fallout after that interview with Fox News Sunday into the week before Christmas. Matt, what was that about? What was the surprise?
I agree with you that it wasn't a huge surprise, but I think many people were just hopeful and optimistic for some parts of the plan. And of course, it depends where you are regionally, because outside of New York and New Jersey and California, people don't care about a lift on the SALT deduction cap. But in the tri-state area, it's pretty key. And even if you weren't optimistic, you still had to be hopeful.
Kayleigh, I've known Miller for a long, long time. Things get personal with him so quickly. This has nothing to do with Matt's big move, does it, Kayleigh?
Oh, nothing at all. Matt's not coming to the tri-state area.
No, not in a couple of weeks. He's not buying a house. Kayleigh Lyons, Matt Miller, Jonathan Ferro, your equity market up 11, advancing 1/4% from New York City. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. A new study says that being infected with the Omicron coronavirus variant can strengthen immunity against the earlier Delta strain. The study comes from researchers in South Africa, where Omicron was first detected. The findings suggest that the likelihood of someone being infected with Omicron being reinfected by Delta is limited. U.S. health officials are shortening the recommended isolation time for people with COVID who are no longer experiencing symptoms. The new isolation period is 5 days, half of what it was. The Centers for Disease Control and Prevention said that after isolation, people with COVID should wear a mask for another 5 days when around other people. Goldman Sachs is standing by its office return plan. That's despite surging COVID infection rates in New York. The firm will make vaccination booster shots compulsory. Goldman told its U.S. workforce that anyone entering offices must get a booster by February the 1st if they're eligible for the shot by that date. And those flight cancellations that disrupted U.S. travel during Christmas weekend continued into the work week. Almost 1,200 more flights were scrapped yesterday after 2,800 were dropped over the weekend. Winter storms added more pressure to airlines, already short-staffed because of spreading COVID cases. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We're now able to purchase 500 million at-home rapid tests to be sent to the American people for free when they request it. And we're going to continue to use the Defense Production Act to produce as many tests as possible. And starting in 2 weeks, private insurance will reimburse you for the cost of at-home tests. But we have to do more. We have to do better. And we will.
The President of the United States there from New York City this morning. Good morning. With Katie Lyons and Matt Miller, I'm Jonathan Ferro. Your equity market positive. 12 or 13 points on the S&P 500, advancing around about 0.25%. All-time highs at a close yesterday, number 69, approaching number 70, perhaps a little bit later. In the bond market, 148.07 on a 10-year. A shout-out to all the analysts out there who have been made to work this week. And Kaylee, maybe a suggestion for the kids at Goldman, the next time they put that deck together, add in a slide about closing the market the week after Christmas. And I imagine, Kelly, they might get what they want next year too.
Well, they got what they wanted this year to a large extent. I mean, not just at Goldman, but you've seen banks across the board making it a little bit easier to work those hours, upping the bonuses, upping the starting salaries. Those analysts at Goldman actually inspired some very real change on Wall Street, John.
Yet they're still working this morning, I guarantee it.
Just
Katie
like
Lyons, Matt Miller, Jonathan Ferro, with an equity market at all-time highs and a bit of trouble down in D.C. for the President of the United States. Joining us now on that is Wendy Schiller of Brown University. Wendy, let's just start there. The President in the last 24 hours saying there is no federal solution. In many ways, that states the obvious when it comes to COVID-19 and coronavirus. But do you think he's lost control of the messaging in a way that he thought he would have control over it when he ran to become President of the United States?
Yeah, Jonathan, in some ways, he's just right back where he started when he first was inaugurated, right? Dealing with a lot of holidays surging on COVID, and the vast majority of Americans were not yet vaccinated. And they were told, look, go get vaccinated and things will get back to normal, or at least as close to normal as possible. And the vast majority of Americans did get vaccinated. Many, many millions have not yet done it, which is part of the problem. But nonetheless, Mother Nature is a very powerful force. And though here we are a year later, and it just feels like deja vu. And I think that's just a really big problem for the Biden administration, which has been doing a lot of things successfully, actually. They've just stomped on their own messaging with the failure of Build Back Better. And then Build Back Better is about more government. And when voters look at government now, they think, well, you're failing us. You're failing us on COVID. You're failing us on testing. You're failing us on care. You know, why would we give you an opportunity to do more when it looks to us like you can't do what you're supposed to do now?
Well, Wendy, the president yesterday said there is no federal solution. This gets solved at a state level. Is that the president trying to shuck some of the political blame away from himself, or is this a president who's just not adequately responding to a national challenge?
Well, I think when we're in crisis, voters don't want to hear blaming on somebody else, even if there are realities where you have governors like the governor of Florida, who's actively trying to prevent mask mandates, prevent vaccine requirements in private businesses, penalize people for trying to take safety measures. You know, he's very popular in Florida, but that doesn't help. The problem is that, you know, that's only one state out of 50. And then, you know, blaming the voter or blaming the person who's not getting vaccinated, that just causes more division. I think it makes communication and messaging to those people harder. I think the issue will be public health. Does the government have the right to do what it has to do, as you're seeing in New York City with the mayor of New York City or President Biden, to mandate vaccines? And the idea of mandate being sort of an unattractive thing to a lot of Americans. We're about to find out whether the Supreme Court allows the government to tell larger businesses what to do. This is going to be a big issue, and this is going to be a turning point in the 21st century for all of America. You know, will we make these sacrifices? Will we allow the government to issue these mandates? And just not clear that's going to happen yet.
Yeah, we'll see how those arguments go when the Supreme Court hears them in less than 2 weeks' time. Wendy, do you think that COVID-19 is the president's biggest political headache right now, or is it something else?
No, I mean, I think it's twofold. It's COVID-19. It's obviously existing polarization and division in the country that he inherited, essentially. And it's also still the fractures in his own party. You know, if he could come out of the gate, now he's not going to have, you know, for the State of the Union, it'll be about COVID. It won't be about what can we do next. He's got to line up the Democrats. You know, at least 23, I believe, have now announced that they're retiring. So he's looking at a pretty lost majority probably for 2022 and beyond and after the election. He's got to figure out a simple thing that he wants that he can get from his own majority party. And they've got to figure that out, too. That's another headache. But things like making life easier for people who struggle during COVID, like childcare, for example, that is likely to be popular among voters who are coming out of a very difficult economic situation and a stressful situation with the pandemic. Think small, think targeted, think what you can accomplish and get that done.
You know, we talked to Mohammed Yunus yesterday from Gallup, and he pointed out that the president's approval ratings have been low since the fall of Kabul and haven't changed much since then. But in the meantime, we've seen inflation really ramp up. And of course, his critics blame that on President Biden. How important is the resurgence of inflation, and what can the president do about it?
Well, it all goes to the same sort of sense of misery on the part of the average citizen. You go to the shelves, you can't find things that you need that you normally can. It's hard to get a new car. It's hard to get a used car. It's hard to get a dishwasher. It's hard to get things that Americans are used to getting relatively easily. And now, of course, that's transferred to home testing for COVID. So it's all about we can't even live the lives we want to live. And inflation's part of that, but it's all going to the fact that it seems as though things are out of control and that the government can't get them back in control. And inflation has become one of another thing that's really fueling this sense of frustration among citizens.
This is delicate, and I want to finish here with you because I think you're the perfect guest to cover it with me. There's something about the attitude sometimes in the administration where they kind of miss the moment. I remember when the press secretary, Jen Psaki, was asked about home testing and basically, why haven't we got home testing? Why can't we do what the UK does, which is basically send a message and you get some the following morning? And she turned around and said, what would you like us to do? Send one to every American. And that's exactly what they're going to try and do now. Do you think they need to adjust a little bit? Just less of the snark, less of the attitude, actually start listening?
Well, I think at least they have to appear to be listening. And I know we're a little bit short on time. I can go a long time on the political malpractice of very experienced politicians who are in the White House now. The president's going to have to shake his staff up. That's what Clinton had to do many years ago. Obama did it a little bit later into his term. You got to shake it up. If the staff that you have now are not serving you well, and you are having messaging issues, you're having government competence issues, at least the appearance of them, you got to make a change. You've got to get people in who are better attuned to this and who can pivot not only the people under the president, but the president himself to learn how to really focus on the things that people are caring about in their daily lives, whether it's policy or it's COVID. and make that the only message you are conveying for the next 3 to 6 months.
Wendy, thank you. As always, Wendy Schiller there of Brown University. Looking forward to catching up again soon. Matt, I can think of several occasions where the president in this White House has been let down by several individuals, including the messaging that came from Secretary Granholm on the gas situation, the oil situation in America. I can think of several more as well, Matt. There needs to be that adjustment. And to Wendy's words, maybe they need a bit of a shake-up on that front.
Yeah, absolutely. I mean, I can think of a few where it seemed like some members of his cabinet didn't really understand the policy for which they were responsible. But you can think of these examples in every administration. We have to say they have a very difficult job, and it's not exactly the easiest climate in which to operate, is it?
Without a doubt. Matt Miller, Kelly Lyons, and Jonathan Ferro, your equity market positive 1/3% from New York City. This is Bloomberg.
An extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the president's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
we're just short of 4,800 on the S&P 500 at the close yesterday. Another all-time high on the S&P for the year 21. We've had about 69 of them pushing 70 now. Kelly and I were talking about this a little bit earlier this morning, about 30 minutes ago. 12 months ago, the highest estimate on the street was 4,400 on the S&P. It was from Goldman and David Costin. And many people ripped them for it. Look at where we are now, closing out 21, close to 4,800 on the S&P. Futures this morning elevated up 13, advancing about 1/3 of 1% on the NASDAQ. We'll talk more about big tech in just a moment. The NASDAQ 100 up another 0.5% on the S&P. That's the equity situation. Let's talk about the bond market and the negative feedback loop that Bank of America's talking about, and why maybe the limit of a move higher on a 10-year is just 2%. That's their call. 148.24 on 10s right now, yields higher by almost a basis point. And Mark Cabana of Bank of America saying that maybe we will be limited with how much higher we can push 10-year yields, because he says ultimately that's going to hit risk assets. You get this negative feedback loop and it caps your move higher on a 10-year. Again, we can touch on that this morning. We've got a lot of time through the next couple of days. I want to finish on this. In the equity market, just a single name. We can talk about Goldman later. I want to talk about Apple. 182.86. That's the line in the sand, isn't it, Katie? Right now, 181.7. We're up about 0.4%. And when you get to 182.86, that, Katie Lines, is your $3 trillion market cap.
It's unbelievable that we're not talking about $3 trillion for Apple when it seems like just 5 minutes ago we were talking about $2 trillion and $1 trillion. The velocity with which this company has added to its value is really quite remarkable, John, and we are really just in an inch of it now. Obviously, it's just a round number. It's not, you know, a massive milestone, but $3 trillion companies are a reality in this market right now.
I have to say, I don't like the round number media
like the
obsession.
Dow. Sounds like Tom Keene.
We don't talk about the Dow. But I will say this, the speed at which we've got there, Matt Miller, has been so impressive. Do you remember, it felt like just yesterday, Katie said it, we were talking about 1 trillion, now all of a sudden we're talking about 3. And an equity, a single name that makes up, what, 7% of the S&P 500?
Yeah, I think that's an even more astonishing figure. You know, the importance of Apple in terms of its weight on the indexes. You have to put it into perspective, though. Historically, it's still not as big as like the Dutch East India Trading Company, which had its own army. So Apple still has a ways to go, I think, before it becomes like nation state big.
I miss Tom too, but that's the most Tom Keene thing you've said, Matt Miller. Oh, yeah. Apple, Katie, 181, positive 0.4% in the pre-market.
And a huge weight in this equity market. Let's bring in Barbara Ann Bernard, CEO and CIO at Windcrest Capital. Barbara, I noticed in your notes you talked about the outlook for U.S. stocks and how much of a bearing tech has on that. To bet against the U.S., do you have to be betting against companies like Apple?
No, I just think you'd have to have a view that there's better relative value elsewhere. You know, when you look at the S&P, this rally has been so concentrated. 5 names account for 23.3% of the index. And, you know, I have to joke, is there a new TAM, which is your Tesla, your Amazon, your Alphabet, your Apple, and your Microsoft, right? To me, the companies that are at their all-time highs are far less interesting than the companies that are at their 52-week lows. And I would add to that, you know, the U.S. has done so well, but that means other places have done less well. And to me, there's more opportunity there. So I prefer Europe and some of Asia. And, you know, I just think there's better opportunity out there if you're into making alpha. If you just want, you know, index type performance, by all means, hold the TAM.
Well, and let's talk about the differences regionally as well and how central bank policy has a bearing, because obviously the Fed is moving towards a more hawkish stance. The ECB, not so much. The BOJ, definitely not. And even China is moving toward easier policy. How does that kind of inform your thinking about regional performance and allocation?
Yeah, well, if you can accept that lower cost of capital increased asset prices, you must be able to accept that a higher cost of capital is going to decrease asset prices. So I think you want to be very vigilant and about where you are investing. And I think you want companies, you know, that aren't predicated on free money. And this is what the Fed just did, right? They just told you that game is over. So that means the winner take all tech platforms of the last decade, that was absolutely the place to be. I don't think that's the place to be going forward. I think you need a different playbook.
How much further, Barbara Ann, can, you know, animal spirits take us to call back to Tom Keene here? I mean, you can forecast earnings growth and you can forecast dividend payouts, but you just can't forecast how much the market is willing to pay, right? Last year, we were willing to pay 30 times earnings at the end of the year. This year, even at 4,800, we're only willing to pay 26 times earnings. Does that number come down?
So, no, I think last year we were willing to pay 30 times sales, not earnings. And I think that's what changes. I think going forward, math matters. And, people will be far more focused on cash flow and asset value because math works on a sum of the parts basis. If the market's not pricing something accordingly, private equity will. And so that's where I feel safe, is where you have that, that margin of safety, which is always math, not sentiment and animal spirits.
But we do have bleeding into that, the incredible sloshing of liquidity, right? I mean, especially when you bring up PE, I just think of the $2-point-something trillion number in dry powder that people throw around every year. I mean, we're seeing massive bids, even at under $50,000. Bitcoin is still worth just under $50,000, right? You're seeing bids for companies that are never going to make any money on Wall Street bets. Isn't this liquidity affecting the market? And as it drains out, isn't that going to change the picture, change the equation?
Absolutely. And I think what we have is we have a bubble in speculation, and draining liquidity drains that bubble. And that's not a bad thing. That's what I'm saying, is the world that I grew up in of traditional metrics based on cash flow are what are going to start to matter a lot more than when when you have a rising tide that lifts all boats. To me, this makes asset management far more interesting and far more rules-based.
Yeah, and of course, the reason that the liquidity tap is starting to turn off is because the Fed feels compelled to do something about inflation, Barbara Ann. And you were way out front saying this is not indeed transitory. Even if it's not transitory, do you think we've seen the worst of it, or is it poised to get even worse than it already is?
Potentially, we've seen the worst of it because now we're lapping higher year-on-year numbers, right? However, I completely see there are a lot of valid arguments for disinflation and inflation, but I am in the camp that we are going to see higher inflation than we have seen in the past for several years to come and even decades. There are a lot of underappreciated factors that are influencing inflation right now. And if you just start with, one of the key underpinnings of inflation is transitory, is that China is going to return to being the disinflationary force that it was over the last 25 years. I don't think it will. If you look at Apple, where they hurt on sales was because of energy and water crises in China, which were curtailing production. China is becoming a little more nationalistic with their scarce resources, and that impacts the global, ability to outsource to them. You look at the cycle of wealth distribution, which we are now in. We have higher taxes. We're going to have higher social spending, higher wages. All of that is inflationary. And Biden's told you he's going to spend $4 trillion over the next 10 years. That is inflationary. You look at the energy transition. That takes investment, not divestment. Again, inflationary. Look at the supply chain crunch. What's going to solve it is higher wages. The pressure point is your truck drivers and your retail, and so that's sticky. So you look at demographics, right? Aging population means we need labor redirected towards old people at the very time that our labor is contracting. All of these things are sticky and not going anywhere and not easy to resolve. The last one is the price of fossil fuels. This is perhaps the most underappreciated one, because what's not being factored in by a lot of governments, but it's starting to, is the cost of the negative externalities of polluting. And you look at countries like Canada or states like California, and they're starting to put in carbon taxes. And when you change the price of energy, you change nature's discount rate, and you change the cost of manufacturing everything. So these are things so when you look at inflation, you have to look at it holistically. And yes, there are some things that are disinflationary, but on balance, I think the average cost of living is going up for the reasons that I stated.
Barbara Ann, that final comment was so important, and I look forward to catching up with you again to talk about it a little bit more. Barbara Ann Bernard there on a situation in this market and on inflation too. Looking ahead to next year, the average read from the economists that we track here at Bloomberg, 4.4% on headline CPI. And Matt, as you and I were talking about who's let down the President of the United States, the messaging, who delivered it, someone wrote in almost instantly on the Bloomberg terminal and said, say it. Say the Federal Reserve. The Federal Reserve. Matt Miller, have they let down this administration this year too?
Well, I thought it was very interesting. I won't say whether or not I think they've let down the administration, but just in terms of the factual timeline, you didn't get the hawkish pivot from Jerome Powell until after he was confirmed. And I'm not sure if that's because of what the market expects from the Federal Reserve or what his political base expects from President Biden. He couldn't really confirm Powell as a hawk, could he? Because remember, there was so much pressure to get him out and put Brainerd in, because his constituency wanted a more dovish leader of the Federal Reserve, even though it felt like Jerome Powell was already very dovish. As soon as he was confirmed, you had that pivot right away.
Shout out to the reporter in the news conference, and Katie, I forget their name, but at the very end of the news conference, Chair Powell was asked about that pivot. What was behind it, and was it linked to the fact that he got a second term? And he gave a pretty detailed answer on it.
It was an exact timeline of all the different data points he had seen. He actually said he was even considering announcing an accelerated taper before the November meeting. And so he said that there were a lot of things that built up to it, definitely trying to, you know, kind of put aside that notion. But it strikes me when we're talking about nominations, John, we still have empty seats that the Biden administration has not yet said who they want to fill them. And to Matt's point, you know, a lot of the progressives didn't want Powell to have a second term. They wanted someone like Brainerd. So do you get a progressive in that vice chairman of supervision role, and what does that mean for the bank?
Someone that might actually make Senator Warren a little bit happier, Matt. What do you make of the potential for that a little bit later this week?
I think it'll be interesting the effects that has on inflation, because this is, I think, one of the biggest problems that the Biden administration faces.
Futures up 11 on the S&P, up 0.2% from New York. This is Bloomberg.
With the First Word News, I'm Rich Gupta. The world has passed a grim milestone. Global coronavirus cases set a daily record on Monday, more than 1.4 million infections. That happened a year after vaccines started rolling out and 2 years after the virus first emerged. The 7-day rolling average of cases was 841,000, which is up some 49% from a month ago when the Omicron strain was first identified. And the UK government has ruled out tighter coronavirus restrictions before the new year. That's despite the rapid spread of the Omicron variant. Health Secretary Sajid Javid urged people to be careful, especially at New Year's celebrations, and has said the government won't hesitate to act if it's necessary. And the coronavirus surge has prompted Apple to close its major New York City stores to shoppers. The temporary move covers 16 locations. Apple will still let customers place orders online and pick them up at the stores. In New York, the jury in Ghislaine Maxwell's sex trafficking trial will begin a 5th day of deliberations. The judge says that starting today, jurors will have to stay an hour later as they try to reach a verdict. Maxwell is accused of luring underage girls to be abused by disgraced financier Jeffrey Epstein. And now tensions between the U.S. and China are rising on a new frontier, outer space. Beijing has complained to the United Nations about Elon Musk's SpaceX satellites. China says 2 of those satellites came close to Chinese space station, forcing astronauts on board to take evasive action. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap between people that were worried about climate and people that were taking action.
Happy holidays from your Bloomberg family.
One of the challenges is that in the U.S. our sequencing was delayed. So while we've made lots of gains in that space since this pandemic begun, we had sort of gotten complacent and we had stopped sequencing everything to understand when these new variants came out. So we're catching up on the data.
That was Dr. Lawrence Sauer there, the Associate Professor at the University of Nebraska Medical Center from New York City this morning. Good morning with Katie Lyons and Matt Miller. I'm Jonathan Ferro. Your equity market up 11, up 0.25%, another all-time high at a close yesterday and set for more of the same a little bit later this morning. Yields are higher by a single basis point to 148.59. We're light on the data front. We're light on the price action too. In G10 in foreign exchange, euro dollar 113.32. Unchanged there, positive by just 0.04%. We are not light on news when it comes to the CDC and an adjustment of the isolation period, down from 10 to 5 if you are no longer experiencing symptoms. An important adjustment. Let's bring in Dr. Amish Adalja now, the senior scholar at the Johns Hopkins Center for Health Security. Doctor, let's start right here, and I think this is so important. Have we just taken a big step towards normalizing how we treat this virus, towards getting back to normal?
I do think that the CDC revised guidance, which was based on science, based on what we've learned about this virus, does give us some sense of normalcy, because what you're seeing is that this is a less disruptive event to get COVID-19 when it's mild, when the symptoms have abated, and we're making that isolation period something that people can more easily cope with within their lives, and we're doing it in a safe manner. It's important to remember that this one-size-fits-all 10 days that have been in place for so long didn't really apply to everybody, because many people were becoming not contagious earlier in that time period. So I think this is more precision guided. I think it's going to be something that people will find much easier to cope with when they do get these mild breakthrough infections that are going to become ubiquitous.
Well, Dr. Adalja, obviously, to even understand that you have a positive case and need to isolate, you need to have a test. And in some cases, you need to have a test to stop isolation and return to your office, for example. Yet testing just doesn't seem to be easily accessible. How does that problem get solved?
This is going to take a full concerted effort by the federal government to incentivize companies to make tests, to make it easier to get these tests on the market. We know we only have a handful that have passed through an onerous FDA regulation process. And I think we have to make these cheaper, because $25 for 2 tests is out of most people's reach. And this is all a result of the fact that tests have always been undervalued, that we really never had a robust home testing program in place during the Trump administration. It started during the Biden administration, but it's been very stulted and flawed and not really optimized. So this is going to be the key part of how we move through this pandemic. As we normalize this, as people want to be able to navigate a life with COVID-19 as being an ever-present issue that they have to deal with, they need these tests. And I think we can't wait until the federal government solves this problem over time. It has to be done now. And I think that this is something that Europe has done very well, but in the U.S. it's just not been something that had been prioritized, because everybody assumed more people would be vaccinated, and that just didn't happen, and we're still stuck in this limbo.
Have we learned now that we can't vaccinate our way out of this, that you need more than one weapon in this war? Or are we just still putting too much emphasis on that in particular?
Well, the vaccines are the best tool that we have by far, because they remove the ability of the virus to cause serious disease, hospitalization, and death. So that has to be the key component of our response. But not everybody is going to get vaccinated, as we've seen. And tests are one way, especially with a contagious variant like Omicron that can get around vaccine-induced protection and cause mild infections. Tests are going to be almost equally important, because people need to know their status. Many organizations don't want to have any tolerance of cases inside their workplace, for example, or at their event. So this is something that needs to be done in order for the country to kind of move forward. Even if all of these cases are mild, there's still not a risk tolerance to have these mild cases, and you still have hospitals that are under stress from Delta patients and now some Omicron patients. That's going to be the key thing. So until we get to that point, this is treated completely like another respiratory virus, tests are going to be something that people want to do very frequently, and it's still a major mess.
How soon do we get there, Amish? Because you mentioned that you expect this to become, these breakthrough mild cases to become ubiquitous, meaning pretty much everyone is going to get it. And it seems like, with 1.4 million new cases yesterday, that's going to be fairly soon. We're not fighting the Spanish flu anymore, even though we still get the Spanish flu, and it's one of the biggest killers. It's just so common. Is that what this is going to become?
Yes, this is going to go the way of the other 4 coronaviruses that cause about 25% of our common colds. So this is going to be something that everybody gets. They'll probably get it multiple times, but it's going to be a tamer version, because our immune systems are going to be trained to respond through vaccines and prior infections. We're going to have tools like antivirals, monoclonal antibodies, and rapid tests so people can know what their status is so they don't infect other people. So yes, we probably will get away from these public health regulations and more towards an individual-based way of dealing with this. The problem is we still have hospitals in the United States and around the world where there are still issues with capacity, and that's the key pivot point for me, is when we remove the ability of COVID-19 to cause hospital capacity concerns. And that is the case in many parts of the country, but there are still areas in the country, specific regions with low vaccination rates, where they're still at risk for too many people with conditions that put them at need for hospitalization that are unvaccinated, that can crush a hospital. That's the point where we kind of move fully to endemicities, when we're not seeing hospitals report over 100% bed capacity in the ICU for multiple days, for example.
So when do we get there? I mean, have we had that in the past with flu seasons that were really bad? Some hospitals get overcrowded. Do we end up next Christmas in a situation the likes of which we would have seen in bad flu seasons 10 years ago, 20 years ago?
Hopefully that will be the case. Right now, it's still worse than influenza seasons, even the worst of our influenza seasons in many parts of the country. That has to be what changes. So probably by next winter, a year from now, we should be at that phase in the United States and many of the developed countries that this becomes handled more like influenza, but I still think it's going to have a bigger burden than influenza for some time because of the attack rate, how many people get infected, and it seems on a pound-for-pound basis to be worse than seasonal influenza when it comes to mortality, but that will all adapt over time, and obviously new variants could come and change that prediction. It might move faster or slower, but I think we're still looking at next flu and respiratory virus season being probably closer to our baseline, but still probably a little bit more intense than usual, but hopefully manageable.
Amish, thank you for all that you do. I know you were busy over the Christmas weekend as well. We appreciate it, sir, for everything you've done and for us this year as well. We'll catch up soon. Dr. Amish Adalja there on a situation, Matt, and hopefully we're taking those steps towards just treating this like we treat everything else.
Yeah, absolutely. I mean, the interesting thing is, for me, is how political will the shots remain? Because, you know, previously people got flu vaccines without making it kind of a Trump versus Biden, Democrat versus Republican thing. But now it seems so ideological that people opposed to vaccines aren't really opposed on scientific health reasons, but really on political reasons.
It's been a bizarre year, a bizarre couple of years on that front, Matt, for sure. Matt Miller, Kelly Lyons, Jonathan Ferro, your equity market up 10, advancing 0.2%. Coming up shortly, Ed Yardeni, the president at Yardeni Research, on why the S&P 500 can breach 5,000 and get a 5,200 in 2022. From New York City, this is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
could end up with a good year, not a great year in 2022.
The market's underestimating the Fed's capacity to tighten.
Inflation will start to decrease a little bit on that year-over-year number.
You're going to see potential for a real divergence in monetary policy.
The early part of the cycle where we see the rapid growth is behind us.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
4,800 just around the corner from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Katie Lyons and Matt Miller. I'm Jonathan Farrow, up another 10, advancing 0.2%. Katie, let's start with that CDC decision. I think it is so important. A sigh of relief in corporate America as the isolation gets cut from 10 to 5.
Yeah, and this could solve huge labor issues that companies across industries are dealing with, John. We saw that borne out in large fashion with the airlines over the holiday weekend, having to dramatically cancel thousands of flights due to staffing shortages, because if you get a positive case, you had to isolate for a rather long period of time. Now that that's cut to 5, do some of those disruptions start to ease, not just for airlines, but retail and maybe for some of those Wall Street banks?
Well, Apple, one of them as well here in New York City. Katie, your read on that, was that down to staffing shortages? What was that about?
They didn't really indicate. It could be a little bit of both, John, trying to protect your employees as New York has a bit of an Omicron problem more so than other places in the country, but also staffing could be a large issue there. It's not just about, people not being able to come and shop in stores. Also, the Genius Bar isn't going to be something you can access, and that, of course, requires a person to be there to talk to you. Maybe Apple just doesn't have that right now.
That stock shaking things off big time in a pre-market and over the last week, that's for sure. Matt Miller, that stock, Apple, in a pre-market, very close to that line of the sand of $3 trillion.
Yeah, I mean, it's got to get up to, I think Kaylee told me earlier, 182.86 or somewhere around there. So it's still got a couple dollars to go, and it doesn't look like it's rallying too much in the pre-market. It'll be interesting. I personally love big round numbers. I also love the Dow Jones Industrial Average, which is why normally I'm not welcome on this program.
Really channeling Tom Keene, Matt.
Well, I just think it makes for a more interesting storyline, and I'm not opposed to that. I like it.
If you go deep into the archives, Katie, there is a program, Bloomberg Surveillance Special with Matt Miller in a bow tie. I think you've got to go back about 10 years, but it exists. Tom Keene, Matt Miller, same program, bow ties. Got to whip through the price action for you. Don't go looking for it. Up 10 on the S&P 500, up 0.2%. I remember Tom Keene being pretty upset with it. Yields higher by about a basis point on 10 to 148.42, euro dollar 113.30. Matt, this equity market, sky high, all-time highs. Katie's been counting all year. We're at 69. We're pushing 70.
Yeah, I think it's fascinating as we watch the equity market continue to climb in the face of Omicron, in the face of inflation, maybe being helped a little bit by more stimulus out of China, maybe being helped a little bit by the fact that the Omicron, the severity of the disease you get with it seems milder. But also, I think it's interesting that we're looking at lower PEs here than we were last year. We talk about how difficult it would have been to forecast 4,800 year-end 2021 at the beginning of 2021, even though we have a guest coming up who did just that. Most people couldn't have guessed it, and we were at a PE of 30 or 31 then. Now we've climbed to 4,800, and we're looking at a PE of 26, so it's still looking pretty strong.
Earnings have been better than expected. The outlook for earnings has improved as well. It's something we haven't talked about enough. On the S&P 500, then all-time highs. Kaylee, if we talk about one sector today, we have got to talk about the airlines.
Yeah, and this comes back to the labor issue in that quarantine period we were just talking about, because they are dealing with some serious staffing shortages. We're going to get more on the outlook for the sector, the staffing shortages, and also just the recovery in travel in general, how the Omicron variant may be throwing a bit of a wrench into that with Helene Becker of Cowen. We'll also be talking about oil, obviously fuel, something the cost that airlines have to deal with. But what is the outlook for oil? Can we actually get to triple digits in the year ahead? Alan Wald of the Atlantic Council will be joining us. We'll talk all things equities up in a moment with Ed Yardeni, but also with Patrick Armstrong of Plurimi Wealth. And then looking ahead to Fed appointments, nominations from President Biden. Will we get them by the end of the year? Good question. But what will the impact of them be? We'll address that with John Riding of Green Capital. John.
Looking forward to catching up with John a little bit later. Katie, thank you. Joining us now, Ed Yardeni, President at Yardeni Research. Ed, Matt mentioned your call earlier this year, looking for 4,800 on the S&P year end. Here we are. It's just around the corner. Maybe we breach that a little bit later today. Ed, you're now looking for 5,200 in 22 on the S&P. Walk us through the playbook, Ed, for next year.
Well, I think the
playbook is basically earnings. 5,200 is only 8% higher than this year, which is going to be probably around 4,800. We got only a few more days left for the market. I think we're getting some feedback.
Ed, we're going to work on that. You take a break, buddy. Just take a second, and the technical team's going to jump in and work on that. Ed Jardini's going to be back any second now, as soon as I get the green light. Go on, Matt. What does it remind you of?
I used to always call in, you know, on radio shows when they were offering free Zeppelin tickets to the ninth caller. I would call in and leave my radio turned up, and I think that's what Ed needs to do. I think he needs to turn down any broadcasting equipment he's got.
Matt, do you want to tell us how long ago that was?
He's still doing it, let's be honest.
Before Kaylee was born. You know, back when Zeppelin was still touring. I was 7 years old and really wanted to see them.
I believe we can try again with Ed Giardini. Ed, hopefully you can hear us this time, and
Yes,
hopefully you're
I
not
can.
getting that disruption. Let's work on what we were talking about just moments ago.
Yeah,
the playbook for 22.
My apologies. The fat finger problem, I think. But anyways, I think the story ahead has got to be earnings. It's hard to imagine that the valuation multiple can go any higher. On a forward PE basis, the S&P 500 has been hovering between 20 and 22 for the past year, which is an incredible achievement when you look at the past. In the past, when inflation started going up and there was talk about the Fed tightening, the PE tended to go down, and yet here it's remained remarkably high at a remarkably high level. Remember back in 1999, 2000, we got as high as 25 on the forward PE, and that was the peak, and then we went straight down. So it's going to be earnings. I'm making the bold assumption here that the PE is going to stay up because there's so much liquidity out there, and earnings should be up about 8%, which is what I think the market will do.
So earnings are going to remain strong. And what do you think about buybacks and dividends? Because this is one of the three key components. I think Barry Ritholtz recently had a piece. He was quoting somebody else who was quoting Jack Bogle, basically saying, if you know what earnings are going to be, you know what dividend or payouts are going to be, and if you know how the market is willing to value those things, then you can make easy calls. Sure. What do you expect in terms of payouts?
Well, I always say it's easy to forecast the market. It's just PE times Z. The trick is getting them right. So again, where I'm sticking my neck out is arguing that the valuation multiple is going to stay high. To your question about buybacks and dividends, I think dividends will continue to make new record highs going into next year. So on that score, we should be fine. Buybacks are also at a record high. Now, I've been sort of contrarian on the buybacks, arguing that not all of them, maybe 2/3 of them, are really associated with employee stock option plans. And so when you have a bull market, companies like to pay their employees, and employees like to get paid some of their compensation in stock. So I'm not convinced that buybacks really have been the biggest driver of this bull market. I think it's been earnings. Earnings have been tremendous. And just to correct the record, I wasn't that good. I was actually looking for 42.90 for 2021 at the end of 2020. I have to admit, this bull market's been, I got the hoof marks all over my back because every time I put out a bullish forecast, it just kind of runs over it within about 3 months. So I've been kind of catching up with this market. I think 4,800, I have to look back, but I think it was around the middle of the year that I started to concede that this thing was stronger than I even thought.
Well, you're humble and not the only one who was caught on the back foot, given the rally that we've seen in this equity market that really no one expected, Ed. But can it only really, especially when we're talking about the multiples and how high they are, can that only be sustained, predicated on the fact that real yields remain so deeply negative? We're still south of negative 1%.
Yeah, well, nobody really knows. We've never seen the real yield quite this low, especially if you look at the federal funds rate versus the inflation rate. And of course, we got a negative real yield in the bond market. The bond market has been very funky. I mean, again, I'm pretty good, but I'm not that good. And I really thought the bond yield would be up to 2% by now. And again, along the way, I learned my lessons and said, well, maybe let's push that out to next year. Something's going on in that bond market, and it may just be that as the stock market keeps going up, people get nervous about the having made so much money, and they're rebalancing back into the bond market. Bond flows have actually been pretty good in the bond funds. So the bond market, the Fed funds rate is probably going to go to 50, 75 basis points next year. But keep in mind, that's only 50, 75 basis points. It's nothing really. Yeah. And all this excitement about tapering and tightening, I think, is overdone.
Ed, thank you, sir, as always. Ed Yardeni of Yardeni Research, just wonderful. Your bond market this morning, your 10-year, up about a basis point to 148.76. Katie, that's been a story for me this year. I mean, Matt mentioned the earnings, and I think that's really important for how well the equity market has done. But for anyone into macro, thinking about the economy, the global economy, and what it means for markets, if I could offer you the outcome of next year, GDP, CPI, unemployment, wages, the whole lot, could you call the equity market accurately? Could you call the bond market accurately? And given the experience of this year, and last year, actually, the previous year, perhaps not.
Yeah, things are just hard to forecast in the pandemic era, John. Even if you get the economic call right, you don't necessarily get the corresponding market call right. And I think it's really interesting as we talk about, you know, when we reach 2%, because we obviously did not in 2021. If it comes in 2022, is the ultimate 2% level what matters, or is it the speed with which we get here? Because, of course, when yields were actually disruptive, it was only about 3 months at the very beginning of the year when it shot up 80 basis points from, 91 basis points to 175 over the course of just 3 months. If it's a slower move in the year ahead, is it actually something that equities need to worry about?
That D word, disruptive. Matt, how disruptive is this going to be? I want to build on what we heard from Jim Karen at Morgan Stanley about an hour ago, who said, don't consider this tightening. This is a move towards neutral. We've got deeply negative real interest rates that will be supportive of risk assets.
Well, it's not tightening yet, right? They have to finish the taper and start working off the big balance sheet. Type FED space BAL go on your Bloomberg to see how much that's exploded since the pandemic started.
Up 11 on the S&P 500, advancing 0.2% with Katie Lyons and Matt Miller. I'm Jonathan Ferro. Lisa and TK back with us next week. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. A new study says that being infected with the Omicron coronavirus variant can strengthen immunity against the earlier Delta strain. The study comes from researchers in South Africa, where Omicron was first detected. The findings suggest that the likelihood of someone infected with Omicron being reinfected by Delta is limited. U.S. health officials are shortening that recommended isolation time for people with COVID who are no longer experiencing symptoms. The new isolation period is 5 days. That's just half of what it was. The Centers for Disease Control and Prevention said that after isolation, people with COVID should still wear a mask for another 5 days when around other people. And Goldman Sachs is standing by its office return plan. Despite those surging COVID infection rates in New York, the firm will make vaccination booster shots compulsory. Goldman told its U.S. workforce that anyone entering offices must get a booster by February the 1st if they're eligible for the shot by that date. Kathy Wood's ARK Innovation ETF is missing out on that Christmas spirit in equity markets. The famous technology fund fell 1.7% yesterday. It's down 22% this year and is heading for its worst performance since its inception in 2014. Last year, ARK was up almost 115%. Zoom and Zillow are amongst the bets that may have hurt it the most. And the price of Bitcoin fell below $50,000 today. The largest cryptocurrency has been sliding since hitting an all-time high of almost $69,000 in November. For the year, Bitcoin, though, is still up roughly some 70%, but investors recently have been pulling back from the most speculative corners of the market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
There is a bill that is the BBB at 1.75 trillion, and I think that that's effectively dead. I think there is a material likelihood, 70% or so, that we get a package that looks more like $700 billion. So something with, less than $1 trillion handle, I think is probably appropriate.
Awesome to hear from Henrietta Trays there of Vader Partners. From New York City with Katie Lyons and Matt Miller, I'm Jonathan Ferro. Your equity market up 12 on the S&P, advanced at 0.25%. We've had 69 record highs in the year so far. Could well become 70, just short of 4,800 on the year so far, higher by almost 28 percentage points. Matt, just quickly, Ivan Akay out on Twitter saying, fun fact, I was once the 99th caller and won Led Zepp tickets. Matt, did you ever win any tickets when you called up?
No, I did not. I am very impressed. I think Zeppelin was actually done touring by the time I would have been legally allowed to go to a concert. I was born in 1973, so weren't they done touring in like 1980? I think that was pretty much the end of it. I wonder when Ivan Akay went. I will message him.
Were you trying to illegally acquire tickets then, Matt? Is that what you were trying to do?
No, I will tell you what, it just popped into my head because I was too young when Zeppelin was touring, but then, and this is a tangent that you probably don't need to hear, but when I was a junior in high school, I think, the local radio station, QFM 96.3, started playing Stairway to Heaven all day long and said, wait for an announcement at the end of the day. So all of my friends skipped school and hung out at a buddy's house. We thought Zeppelin was getting back together and touring again. It was going to be the most exciting thing. We were all planning on dropping out of high school and going on the tour, but it didn't happen.
Matt, if there was a week for this tangent, it was this week, all right? That's it, never again. Okay. Yeah. Ellen Wald joins us now, Senior Fellow at the Atlantic Council. Ellen, let's just start with your line right here. The US could be in for its own rude awakening when it comes to energy prices for the rest of this winter. We are currently seeing a complete dislocation of our typical utility prices. Ellen, what do you mean by that?
Yeah, this is actually something that has been building for about a year now, and we're seeing it get even worse. If you look at the utility prices and the price of energy, typically pattern is that these prices trend downwards in the winter and upwards in the summer. However, starting last year, we stopped seeing this downward trend during the summer and instead are just seeing prices continue to rise. And this has been continuing over this past summer and through October and November, if you look at the average electricity prices. And this partially has to do with the fact that the United States is much more reliant now on natural gas and for electricity than we have ever been. Of course, this has been a good thing. We've cut our emissions a lot, but it's affecting our electricity prices in a very severe way. And it does seem, even if winter isn't especially cold, that this is going to be contributing to increases in household electricity prices throughout the winter.
Well, and of course, what we're seeing in the U.S. is nowhere near as bad yet as what they're seeing in Europe. And of course, Russia has a serious role to play there, given the political delicacies in the relationship between Russia and the West. Do you have any reason to believe that is a problem that can easily be solved?
I don't think this is a problem with an easy solution. And in fact, the potential for the U.S. and U.S. intervention to actually worsen the situation is there and is definitely something we need to keep an eye on as we enter 2022. Right now, the situation, particularly if you look at the situation in Russia, they're experiencing record cold. Yes, Europe has gotten a bit of a reprieve as we've seen more LNG cargoes headed from the U.S. to Western Europe. But if you look at what the situation is in Russia and then how that impacts Russia's gas exports to the rest of Europe, it's not looking good for the rest of winter, particularly if things get colder in the rest of Europe. Combined with the fact that we've got this geopolitical situation going on with the Ukraine, there's a potential for NATO or the U.S. to put some sanctions on Russia. Any kind of sanctions, even just financial sanctions that impact the SWIFT system, could impact Russia's ability to sell natural gas and other energy products in Europe, which could have a very catastrophic effect given the tenuous situation with energy in Europe.
Ellen, as we much ado has been made about electric vehicles this year and into next, I'm sure that'll continue. But is it possible that we'll see real adoption of this technology? Because I note when I look at urban centers around the world, there still isn't really any place to charge these vehicles.
Yeah, EVs, we see a lot of predictions saying that, the EV market is primed to explode. A lot of these car producers are getting very heavily into producing a lot of EVs. The question is there really a consumer market in a large scale for EVs? And I just don't see that happening right now, both because of the price point and the limitations in terms of range and charging. And that just doesn't seem to be there yet. Yes, there are, at least in the U.S., there are plans to build out larger charging networks, but that's going to take time. And the question, is kind of, well, what do you put first, the carrot or the stick? And it really does seem to be very difficult to push EVs on people who, when they're making that calculation, just don't seem to say, look, an EV just doesn't make sense for me right now.
Ellen, brilliant as always, the author of Saudi Inc., Ellen Wald. Ellen, thank you. Thank you very much. Matt, let's get personal again. Is the order in for the F-150 yet? Has that gone in?
Well, see, this is the issue. I want a big truck, not necessarily a gas guzzler, because the F-150 does still use the EcoBoost V6. My wife is saying she wants an electric car, and she leans towards, Volvo-ish kind of things. But I don't know where I would charge it. Is there a charger near our global headquarters at 731 Lex? I don't think there is.
I haven't looked. I imagine you'll find out. I assume the wife wins, Matt. The wife wins. I can't imagine you driving a Volvo, though. She's the boss, but does she get a Volvo?
She would drive that. Then I would get something else like a Mustang GT 500 in order to, quench my thirst.
What happens with the cars you currently have in Berlin, Matt? They stay there?
I've got to sell them. You know, you can't buy cars, even if they make those models for the U.S. market, you can't buy them in foreign markets and then import them to the U.S. unless they're over 25 years. It's a really odd rule, clearly created in order to encourage sales inside the borders of the United States.
But the 911 that you took over from New York to Berlin can come back from Berlin and back to New York?
That
can happen.
That can come back.
Are you going to sell that or are you going to keep it?
No, I'm going to keep it. It's got the 3.8-liter flat six. I mean, Porsche's never going to build a boxer engine that big again. It's amazing.
There we go. Is it worth more now than what you paid for it, Matt?
It's worth more now than what I bought it for. Bought for in 2014. Yeah, of course.
Seriously, 8 years ago.
Yes.
Unreal.
Yeah. And I've put 30,000 miles on it. Great investment.
Matt Miller, Kelly Lides, Jonathan Ferrer. I imagine Mrs. Miller didn't consider it a great investment at the time. Futures up 13, advancing a third of 1% from New York City. A lot of men right now, Matt, telling their wives, you see, it'll be worth more in the future. Let me get it. From New York, this is Bloomberg.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
More of the same in this equity market. Live from New York City on TV and radio. This is Bloomberg Surveillance, and here's the price action. Up 13 on the S&P, advancing about 1/3%. On the Nasdaq 100, up about 0.5%. The Russell does not sit this move out. Up 6, advancing 1/4%. The story for 22 for many people, the relationship between the equity market and the bond market, is often a story. So let's talk about that and blend together the work of Bank of America with the work of Jim Karen over at Morgan Stanley. Switch at the board and get to the bond market and sit on 10s just for a moment. Right now, 148.24. The call from Mark Cabana over at Bank of America, 2% year-end next year on 10s, and a limit to that move because of the negative feedback loop from equities and risk assets back into bonds. The idea being that if yields go too far, risk assets start to break down a little bit, back into bonds, yields lower. So we capped at 2. My question would be, how high do we go before we hit that threshold? So Jim Karen and Morgan Stanley's work comes in handy here. He's saying this is not about tightening. This is about a move back towards neutral. And Katie, given how deeply negative real interest rates are right now, how far can they go before actually causing any disruption in this equity market, in this credit market, with spreads still fairly tight?
Yeah, I mean, the real yield on the 10-year is still sitting at what, negative 106 basis points. These are deeply, deeply negative, and they likely will still remain negative. So even if a 50 basis point move higher happens, you're still sitting at negative 0.5%. I think the question is maybe not so much how quick or where it moves, but how quickly it does so. If it's a move that is too fast, that is what could take equity markets on the back foot.
And the last time we had some real disruption, Matt, off the back of Fed policy, go back to the end of 2018, December of 2018, we were positive 100 plus on real yields there. Complete opposite of what we're experiencing, Matt, at the moment.
Yeah, and I wanted to point out also, I didn't get to when we were talking to Ed Yardeni, you know, he coined the term bond market vigilantes, and where are they right now? As we go into an era where the central bank is reducing its purchases or even starting to unwind its balance sheet, and government issuance may grow, why are we looking at 150 on yields?
Inflation pushing
negative 1% on real yields.
Inflation pushing 7. Unreal, 148.24 right now on 10s on your nominal yield. We can talk more about this through the week. As I say, we've all got a lot of time on our hands.
We will.
Let's finish on this one. In the equity market, it's Apple. I'm not a big fan of round numbers and all of that jazz in the media, but we're going to play that game, no doubt, through the day here at Bloomberg and elsewhere. 118.98. What's the line of the sand, Katie? 182.86.
That's correct, John.
That's your line of the sand to get to 3 trillion. Right now, we're positive again, up 1/3% on that single name in a pre-market.
Yeah, John, growth still winning. That growth over, or value over growth trade that was supposed to be the story in 2021 didn't really play out. That whole we're going to 2% on the 10-year didn't play out either. And also what didn't play out was a weaker dollar. That strong dollar persistently throughout the year, catching a lot of people by surprise, I think. Stephen Englander, Global Head of G10 FX Research at Standard Chartered, joining us now. Steve, do you think we're getting closer to peak dollar strength?
Well, we're getting closer, but we're probably not there. The support for the dollar is slowly ebbing. There were 2 factors driving dollar up. One was the fear of COVID and the disruption that it caused. And the second is the fear of the Fed. So we're seeing COVID fears ebb very gradually. What remains to be seen is how quickly the fears of the Fed, and that's going to be triggered by the market, the fears of the Fed ebbing, and that's going to be triggered by the market seeing a peak to U.S. interest rates. So I think that we're not there yet. We need to see some sign that inflation is hitting a top and that there's more downside than upside. But I think on the COVID side, it's what's lending support over the last couple of days to other currencies against the dollar.
Well, and talking about the Fed and really central banks across the world and their policies that in some ways are diverging, do you think that monetary policy divergence will be the key driver for FX in the year ahead?
Not so much. I think it's actually going to be the question of, are we in a cycle that's going to be extended where, you know, if the Fed is right, they hike 3 times next year and they continue hiking and the markets kind of worrying about how far they're going to go, or whether we actually do begin to see some evidence that inflation is ebbing. I think the dollar, broadly speaking, is very risk off as a currency. It's, you know, it's kind of the Japan of this decade in terms of its risk off properties. So I think any indication that the globally central banks don't have to be as aggressive as the market now expects them to be would be a strong dollar negative.
It's funny you mentioned Japan. We were, Kaylee and I, talking about Japanese inflation a little bit earlier. It's finally coming back above the zero line, and this is an economy that could really use it. What do you see in terms of the yen?
Not so much. Look, we think it's going to lag. The economy isn't really that strong. Because they don't have an inflation problem, they are one of the central banks that really don't have to worry about raising interest rates or sounding aggressive on monetary policy. I think if the dollar falls broadly, the yen will fall with it, but it's not going to be the top tier of currencies. It's going to be a funding currency as far as the eye can see.
What about the euro? As John points out, I often make things personal here. I'm moving back to the U.S., and it's painful to see us back down at 113 when we were all the way up in the 120s. Any movement that you see there, considering the Fed on the front foot and the ECB as a follower?
Well, I think that that's one case where monetary policy divergence does matter. I think that the shift of the Fed is towards sounding more aggressive, the ECB's adamant view that they don't have an inflation problem, what they see is transient. I think for the euro to strengthen, and this may not work for your timing, we may have to wait for the ECB to say, come to think of it, maybe inflation is going to be more persistent than we thought, and monetary policy won't be as easy for as long as we thought. But that might take a few months yet.
Steve,
but that would strengthen the euro.
Away from the euro, we can get back to that currency pair for Matt a little bit later this week, no doubt. Steve, a theme of this program over the last several weeks is just how much hiking we need to see from this Fed before it becomes actual tightening. Jim Carroll of Morgan Stanley weighed in on that a few hours ago. Steve, have you got an idea of the level of that in mind, of how much hiking they would need to do to actually see a tightening of financial conditions?
You know, that's the toughest call there is, trying to understand why long-term real interest rates are as low as they are, even when the economy seems to be picking up. It's possible that we've injected so much liquidity into the market that the market fear is that even a modest degree of tightening will end up creating a financial event. And so the long-term real interest rate level has been marked down, at least until there's evidence that it could sustain higher real interest rates, which we haven't seen in a while. But it's, we're reluctant to think that the Fed can go that far. Plus the U.S. economy is great now because a bunch of people sort of looking for work, they lost their benefits a few months ago. They're, the market, they're looking to get picked up. By the time we get to the middle of next year, all of those guys will have been soaked up, and what will be left will be this nugget of people that, workers who really are having hard times getting jobs. So the perspective on how far yields can go and how far the Fed can go will, could be very different 6 or 8 months from now than it looks right now.
Steve, I just want to go back to that just a little bit more and spend some time on it if you can. You're saying the most important feedback loop, the relationship between the bond market and elsewhere, is with risk assets and not with the real economy.
Well, it's possible, right? Those loops and feedback chains have not been established. But we know that after having a decade of easy money, people have done what they do when there's easy money. What we haven't seen is how they react when that easy money gets pulled back, and whether or not the financial chain ends up being more important and, say, more abrupt if it looks as if the Fed is really serious about raising rates than either the market or the Fed anticipates. There's a bit of that built into the 10-year, right? And that could be part of the explanation why 10-year yields are so low.
Fascinating conversation, Steve. Just wonderful as always. Steve England there of Stanchart. Thank you for everything this year as well, Steve. Just brilliant research coming from you over the last year and, of course, going back further than that. Matt, I know you feel bad about where the euro is right now, 113. I managed to move just before Brexit. Can you imagine how much worse that could have been for me? Early 16, I think we just broke down through 150 on cable. If I'd moved 6 months later, 7, 8 months later, 9 months later, it could have been vicious.
Do you think I could put off? I was scheduled to fly back a week from Friday. Do you think Al from New Jersey would mind if I just pushed that back 3 or 4 months?
What? Or maybe 3 or 4 years and wait for that first ECB rate hike, Matt. You think you could delay it that much? Matt Miller with us this morning alongside Katie Lyons. I'm Jonathan Ferro. Just to whip through the price action for you. Up 13 on the S&P. If you're tuning in, yes, the market is open stateside. No, I have no idea why. Yields are higher by a basis point on a 10-year at 148.24. Euro dollar, as I say, at 113.33. And Katie, I think you picked up on this a little bit earlier on crude. We're back at 76. 76.72 on WTI at 1.5%.
Yeah, the highest level for crude in a little over a month, John. And what's interesting is you still have a lot of the questions out there as far as demand. How is the Omicron variant going to impact that as you start to see, more restrictions being put into place, and the supply question as well? Maybe the oil market is a little bit more confident in striking that balance given, a shorter quarantine period, that it seems to be less severe. But oil has been extremely volatile over the last several months, and I wonder if that's a story that continues in 2022.
Matt Miller, crude positive this morning.
But absolutely. I just want to make 2 points in terms of the rally. One is, yesterday you were talking about the possibility of the CDC reducing the time you need to quarantine from 10 to 5 days. Now they've done it, and I think that's bullish this market, especially as we saw so many flights canceled.
Matt,
I also want to
totally
clarify.
agree with you. I'd agree with you. Go on.
Yeah, no. I also want to clarify that it's Omicron.
Depends on who you
ask. As opposed to Omega, just so you know.
Matt, I'm just hoping we never have to talk about it again in a couple of weeks, and then we won't have to debate how to pronounce it. Equities up 13 on the S&P, up 1/3 of 1%. Thank you for weighing in, Matt Miller. You're tired. That must have been driving you nuts for the last month. 148.24.
It's been a problem.
Been a big problem, apparently, yeah. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. It's a record that many thought we'd never see. Global coronavirus cases set an all-time daily high on Monday, more than 1.4 million infections. That happened a year after vaccines started rolling out and 2 years after the virus first emerged. The 7-day rolling average of cases was 841,000. That's up 49% from just a month ago when the Omicron strain was first identified. The UK government has ruled out tighter coronavirus restrictions before the new year. That's despite the rapid spread of the Omicron variant. Health Secretary Sajid Javid urged people to be careful, especially at New Year's celebrations, and he said the government won't hesitate to act if it's necessary. And now tensions between the US and China are rising on a new frontier, outer space. Beijing has complained to the United Nations about Elon Musk's SpaceX satellites. China says 2 of those satellites came close to the Chinese space station, forcing astronauts on board to take evasive action. The transport industry is bracing for another rollercoaster year of supply chain disruptions. A trade group estimates that 1/5 of all professional truck driving jobs are unfilled. Many drivers are concerned about COVID-related border closures. The shipping industry faces similar labor challenges. Companies are having to hire sailors from other firms and offer them good bonuses to sign on. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
from the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Protesters breach the Capitol.
Container ship blocking the Suez Canal.
Types of crypto coins.
Crackdown on tech in China. And the billionaire space race.
Delta variant.
Chip shortage.
Rising energy prices.
The Omicron variant has
going to be a little bit better than people anticipate in the first quarter because we're going to have strong earnings. Yes, valuations may come down some, but I think we'll have strong earnings. I think we'll have good growth. I think we'll start to see inflation pressures ease a little bit, and that's going to allow the longer end of the curve to go and maybe steepen the curve a little bit.
That's the constructive view from Victoria Fernandez, the Chief Market Strategist at Crossmark Global Investments, with Claylee Lines and Matt Miller. I'm Jonathan Ferro. Your equity market up 13 on the S&P, advancing about 1/4% after another all-time high to close yesterday on the S&P. Yields are higher by about 0.5 basis point to 148.07. Euro dollar unchanged at 113.32. Talked a little bit about crude, 76.66 at 1.44%. Matt, you mentioned earlier the change in the multiple this year. That's been a story. It's been about earnings in 2021.
It is, and I think Ed Yardeni said he expects earnings to still grow 8% in 2022, which is better than a stick in the eye. I mean, the multiples come down from 31 at the end of last year to 26 at the end of this year, and it's one of the key parts you need to know, or at least forecast, in order to guess where markets are going to be, along with earnings and payouts, of course. So
simple,
I think it's interesting that investors are willing to value stocks, are not willing to value stocks as highly as they were at the end of last year.
When you look at the division between the likes of Morgan Stanley at 4,400 and say the likes of, is it Oppenheimer, Invesco? John Stolfus looking for 53.30 on the S&P. That's the high against the low. Morgan Stanley and Mike Wilson, Katie, looking for that multiple to come down, to come in. Given what's happening with tapering, they believe it's tightening, and given what could happen with interest rates at the Fed too.
Yeah, saying repeatedly tapering is tightening for this market. I know some would disagree with that thesis, but Mike Wilson is interesting. Obviously thought that the market would end a lot lower this year than last year. And what the high end of the forecast for 2021 were at the end of 2020, 4,400 was where David Kostin thought we'd end this year. That's where Mike Wilson thinks it's going to end next year. It's not a call that went right for him this year. It'll be interesting to see if he is a little bit more right next year on that.
If you are betting against this market, can you bet against these big names? Apple heading for a 5th straight daily gain. The 3 trillion line in the sand very much in view. Let's get to Bloomberg's Kriti Gupta for more. Morning, Kriti.
Well, good morning, John. 3 trillion is certainly the magic number, but to get to that, we're looking at a share price of $182.86. Apple trading around 181 in the pre-market right now. So we are inching closer to that. So for my chart of the day, John, I decided to look at what happened the last time Apple looked at 1 trillion or 2 trillion. You actually saw a 40% decline when you're looking at its drop at 1 trillion in 2018, and then a 20% decline just last fall when it hit that $2 trillion market cap. Of course, we look at this on a logarithmic scale, as Tom Crean would like. The big question here is, does that mean when you hit 3 trillion, you'll see another drop? Because, John, one of the big questions here is that, yes, big tech leads the benchmarks to those record highs. You saw one yesterday. You could be seeing one today as well. It also leads those corrections. So could this potentially signal a big macro correction that may be in the cards?
I really hope Tom is watching and or listening today, because we're quoting the Dow. Matt Miller is talking about history. Kriti has a log chart. Kriti, when we talk about the Apple story, though, and what's going on aside from just the equity price action over the last 24 hours here in New York City, they've started shutting down stores. How indicative is that of a more macro story?
Well, this is crucial to what you're going to hear in the macro space, specifically because this kind of brings back what you saw in the summer of 2020. Remember, this was before we had the vaccinations, while we were still dealing with lockdowns, a big hit to summer demand, not only in disposable income, but that classic driving season was kind of under wraps. And one of the big indicators for the market where you actively saw the S&P 500 on an index level trade off these headlines was when Apple decided to kind of close their stores and really kick off those, or I should say shut down those kind of services that they had. The Genius Bar, for example, was shut down specifically in New York, but also across the country. And this is how you saw a lot of that recovery trade first emerge when Apple started reopening their stores, not only in New York, but in LA, in Chicago, in Dallas. And that ended up kind of becoming a proxy for this broader reopening. And the reason for that is because Apple is actually kind of a proxy for that luxury demand, for that consumer income, that disposable income that they're willing to spend on luxury products. I know everyone has an iPhone these days, but iPhones at the end of the day are a luxury product. Add that on to the foot traffic you need to get in for their services that Apple provides for, of course, attuning to all of their products, and you kind of have this little macro proxy built into the stock.
It's true. I need to get to the Genius Bar. Ever since the software refresh on my Apple Watch, it runs out of battery in like 10 hours and sleep mode isn't working. Do you know how to... Do you have any idea?
We'll have to get that fixed. I'll make a call to Tim Cook. We'll see if he can get right on that.
John was making an interesting point yesterday, or talking about the importance of reducing the time that people need to quarantine after testing positive for COVID. It was 10 days. Now the CDC overnight has reduced that down to 5 days. This is bullish for markets, isn't it? Because airlines that were having to cancel flights, or Apple, maybe this is one of the reasons they had to close their stores in New York, aren't going to need that if they can get a deeper bench, more people, and not only for the corporate world, but also for healthcare, right? If you have more first responders able to go to work, that's a good thing.
It is, in theory. The idea and the key word there is if you're asymptomatic, to get that kind of lowered quarantine time, especially because I think CDC officials and health officials, health experts point to those first days of infection as when you start to see you potentially be more and most contagious. Now, this isn't just about Apple now when it comes to the labor market, but it also comes to things like airlines. We were talking about this yesterday. A lot of those flight crew shortages, pilots, this new kind of step from the CDC could actually make it one step closer to treating the coronavirus like a flu, essentially, in the long term, where if you have a flu, you don't have to quarantine for 5 or 10 days. You just have to deal with it. And then once you feel sick and you're not contagious anymore, you can come back to work. So this would, on that front, be a positive for a lot of corporate America that is dealing with those labor shortages.
Kriti, thank you. Great work as always. Kriti Gupta. And just to build on what Kriti was saying there, Matt, can you imagine how stressed out some management teams were looking ahead to early 2022 and wondering how they were going to staff their teams with a lot of people getting it and facing 10-day isolation? I am totally on board with you. This is a major step towards making this much, much less disruptive for this economy, for society going forward from here.
Yeah, no, absolutely. And if it continues to move in this direction, we get to a point where people start just coming to work when they're COVID positive, right? Like they used to when...
Yeah, Matt, let's not go back to that. Yeah, let's not go back to that.
Show up at the office anyway.
We mentioned this yesterday. Let's not do
heroic.
that flu and go back to work business. I hope we move away from that. But Matt, think about where we've come from. 18 months ago, I remember the summer of 2020, you were in a 14-day quarantine if you traveled into the UK. Even if you were tested negative, you had to stay there. Man, that's a big change.
That's the biggest difference, John, because to be honest, you know, a lot of people, for instance, if you or I had gotten COVID over the last couple of years, we would have been able to work from home. And I'm sure that a lot of people on Global Wall Street have been working from home after testing positive as well, certainly if they were asymptomatic and able to do so. But traveling is not an option. So that's where the really big difference is made. And I don't think the CDC guidelines are changing that yet.
Just one final word, Matt. I'm not big on conspiracy theories, but the Apple thing, totally with you. Every single time they upgrade the software, the thing shuts down, you need to get a new one. Come on.
Yeah, and I am big on conspiracy theories. So.
I know you are. I know you are. Matt Miller, Katie Lyons, Jonathan Ferro, your equity market up 13, advancing a third of 1%. This equity market just churning out another all-time high after all-time high, another record high in sight. From New York, this is Bloomberg.
How all that chocolate makes it to the supermarkets in time for Christmas. I'm James Walcott, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, Toffee Crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. So this Xmas is its first big test, and so far, it looks like things are going well.
From New York City.
We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
You're going to have to get the call right on whether the market or the economy can absorb 3 rate hikes.
This is such a flat curve for the Fed to start hiking.
The Fed has to respond more aggressively to inflation.
I feel pretty confident the Fed is probably more right than the markets right now in terms of tightening.
The possibility of a mistake is relatively high.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Katie Lyons and Matt Miller. I'm Jonathan Farrow. Your equity market up 13, advancing about 0.25% on the S&P 500. Katie, in America, where the CDC has just made a big decision to ease some of the disruption associated with this virus.
Yeah, 5-day isolation period now instead of 10, something that is going to be welcome words to hear for a lot of corporate America, dealing with labor shortages, having to shut their businesses, having to cancel flights due to a lack of staffing because of the virus. John, it is a step toward normal and treating this less like something that needs to be treated in a particular way versus any other illness.
And Katie, in many ways, Goldman Sachs on board. Let's get back to work. Let's get back to the office. Of all the banks on Wall Street, Katie, that's the one making a big push going into next year.
Yeah, Goldman was out front saying people are coming back. They were one of the earliest banks to do so at a time when even Wells Fargo still hasn't brought everyone back into the office. They've pushed that back indefinitely. But Goldman definitely is taking stock of the moment. They are requiring those employees coming into the office to be boosted by the 1st of February and making them test twice a week. So it's to the office with some caveats.
We speculated about this through the summer, Matt Miller, and here we are. To be fully vaccinated, for the likes of Goldman at least, and others I know, to be fully vaccinated includes that booster.
Yeah, absolutely. I mean, they were already, I just traveled to Spain and back, and they were already checking to see if I'd had a booster to get into certain restaurants. Kaylee made an important point, I think, earlier, which is that a lot of companies are going to be stricter than the CDC guidelines. And we also had a viewer on Twitter who wrote and said, look, Apple is going to make its own policy, and it's going to probably be stronger than the CDC guidelines as well. So banks, retailers, restaurants, airlines, they're going to all be able to make more conservative policy than the CDC guidelines, and that's important to keep in mind.
Let's whip through this price action ahead of that conversation. Futures up 14 on the S&P, advancing 1/3%, a record high yesterday. You know the number, a 69th all-time high on the S&P 500 in America for 2021, about to become 70. At 14, advancing in the equity market, yields are not doing much on 10s, up almost a basis point to 148.24. Crude up by 1.6% to 76.77. And euro dollar, someone help out Matt Miller, 113.27. Where do you need it to be, Matt? Where do you need it to be? 113.27. What do you need?
No. To be fair, when I moved over here in November of 2016, we were, I think, around 105, 106. So it's a little bit better than it was then. It's just that I saw it up in the 120s, and I felt like it would be more lucrative to me if it climbed. So I've been watching it more closely lately than I typically.
You weren't alone, Matt, and I think, Katie, coming into 21, it was one of the calls that didn't quite work out. People thought we'd have the global synchronized backdrop, global synchronized growth, which intuitively would lead to a weaker dollar.
Yep.
That lasted about 5 minutes, and what we've had is a year of a stronger dollar, largely off the back of what's happened against the euro.
Yeah, that strong dollar coming in to punch a lot of those calls in the face, John. But I would note it's not the only call that didn't necessarily work out. The call was also for value to outperform growth. That's not something that worked consistently throughout the year. All said and done, it actually underperformed. Same with small caps versus large, U.S. versus the rest of the world. All of those things that were supposed to be the story this year were not. The question is, do those actual rotations start to take hold in the year ahead?
Let's start that conversation now with Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Patrick, good to catch up with you, sir. The things that are set to come under pressure into 22, Patrick, what pockets of this market are you avoiding?
I think it's not going to be a year where you want to try to get rich. I think for the last 3 years, we've had massive liquidity in the system. We've had central banks buying bonds, trillions of bonds, and it's going to be an environment where liquidity is slowly taken out of the system. And I think the meme stocks, the high growth, no earnings stocks, those types of story stocks, they've come under pressure since November. And I think that's going to continue. I think if you're making an investment for 2022, you want to have a valuation thesis at least. You have to understand that this company is generating cash flow, generating earnings, and it's not ruling out all tech companies. But I think the companies that are at the most extreme multiples, that they're going to be category killers, but that's 5 years out, I think those are going to come under pressure as liquidity gets removed from the system.
But what about the other tech companies that some may put in the kind of quality basket, Patrick? The likes of Apple, which is approaching $3 trillion in valuation, that are consistently strong earnings growers. To bet against the U.S., and I know you're underweight the U.S., are you also saying that you expect some of those large heavyweights to start lagging?
Where I've got my U.S. exposure is those large heavyweights. So I'm very comfortable with Apple. We actually sold Apple earlier in the year in February, which was, looked like good timing. We did it just before their earnings, but we bought it again about a month ago. So I'm back into Apple. I own Meta. I own Alphabet. So my U.S. exposure is underweight versus the MSCI World Weight, but I'm taking it with the big cap tech companies because just their cash flow is enormous. Their multiples aren't cheap, but totally defendable. A 30 times multiple or 30 times earnings for the kind of growth and profit margin they generate, I totally can justify. So I feel comfortable to own them. But there's many industries where like for like, stocks just trade at 30 to 50% premium if they're listed in the United States versus if they're listed in Japan or if they are listed in Europe. So the other more traditional sectors that aren't tech oriented is where I'm overweight other countries.
Yeah, I was just going to ask, I mean, I'm sure you're not betting against the United States, but really on other countries where you see undervalued assets. Where is that?
Well, I've been talking about it for a year, and the companies have performed incredibly well. And I think every time I've been on your show for the last 15 months or so, I talk about Moeller Maersk, Hapag-Lloyd, and I don't get my head around. They're trading at 4 times earnings. How negative do things have to get for shipping rates to really make it be a 4 times earnings on Moeller Maersk? So it's probably up 60% this year, but earnings are growing as fast as the share price is growing, and it's just incredibly cheap. ArcelorMittal, I do think infrastructure spend is going to happen in the United States. I think Europe's going to get around to infrastructure spend. Japan's doing it as well. I think steel is very cheap. Company like this is trading at 6 times earnings. So there's companies that are domiciled in Europe. They're global companies benefiting from the global recovery, but they're just trading at very low multiples, and they actually have very high earnings growth potential, in my opinion.
Patrick, of those companies, the likes of Moeller Maersk, some of the miners, some of the energy players that have seen huge demand for their goods, and the underlying product or service has seen a great gain in price. Have you seen the corresponding discipline when it comes to building out capacity, Patrick? Because that's been the worry of what's happening in the shipping industry in the previous few decades, what's happened in mining and energy in the previous few decades as well. Is that what's different this time around, Patrick, into 22, that they haven't made those big calls, those big investments into capacity that could haunt them in years to come?
They haven't. They're producing tons of cash flow, so it's always a risk when a CEO's got so much cash, doesn't know what to do with it, expanding, investing, assuming that these profits and freight rates will stay where they are. None of the CEOs are talking like that. There's none of the hubris about this is going to last forever. They know this is a cyclical windfall that they're really monetizing. I think it'll probably lead to some consolidation in the industry, which may streamline capacity. It'll give more pricing power. And I think those kind of expenditures make sense. You can preserve your profit margins with that. I don't think a big, massive build-out is what any CEO is talking about of new shipping. So they're being built, but these take years of lead time as well.
Patrick, I noticed as well, you say you want to own volatility in the year ahead. Why and how specifically?
Well, QE, what it does, it's unclear. No one knows unequivocally what QE does for the economy. It probably gives it a boost. It gives some confidence when times are very scary. QE basically brings out some animal spirits and provokes some investment. But what it does 100% is it suppresses volatility. And as QE gets removed, the market forces will just be allowed to react to scary things that happen. When something happens in the past, you used to get a sell-off, it'd be a buying opportunity. Over the last few years, buying opportunities last in the spans of days rather than months. So I do think there'll be some sell-offs that maybe will last a few months where you get a official correction and some things then get too cheap and that provokes some buyers. But there won't be the wall of money chasing every single sell-off. And I think when you can have dips, that's the definition of volatility. And I don't think those will be suppressed as much as QE gets removed in the first quarter of next year.
Patrick, I just want to build on what you think will spark the disruption. What we saw in the previous cycle, what we saw was ultimately no real disruption until real rates got through positive 1%, until we actually started to see some balance sheet reduction and not just the unwind of QE and net purchases, Patrick. Are you saying that could happen this time around before we get to those kind of points?
Well, they're bound to be before we get to this kind of points. But the thing that's kept me in equities, there's three pillars, and thank God I look at them because I worry about valuations. And the S&P 500 is at 3.5 times sales. It's never been higher than it is today. But massive liquidity, negative real yields, and earnings growth, while those pillars remain in place, I think equities do move higher. I don't think we need real yields at 1% to provoke a correction, but if we get down to less than 0.5% negative real yields where the outlook for treasuries is moving higher, I think that'll provoke some multiple contractions, and I do think it'll be the highest growth companies with the most extreme multiples that are impacted the most. Companies that are trading at 30 times earnings, very expensive, but you can see how those big cap tech companies grow their way into those multiples, so offsetting a multiple contraction with earnings growth.
And Patrick, before you run, just let me squeeze this one in. You brought up AP Moller-Maersk, a company I used to follow really closely when I was doing some work out of London. Of course, that company out of Denmark. Guy Johnson and I used to talk about this all the time. I'm not a big fan of stock splits, but of all the names, Patrick, in Europe, does that company need one, given what it's trading at right now?
Yeah, it precludes retail investing. Europe isn't as much of a retail investor market anyway as in America, so I don't know if it would incrementally create demand. But yes, definitely that must open up the shareholder or the potential shareholder base.
Patrick, thank you, sir. Good to catch up. Patrick Armstrong there of Plurimi. And Matt, for those that don't know, in Danish kroner, 23,280 is where AP Moller-Maersk trades. Futures up
very
13.
Fun company to visit.
Up a third of 1%. They are, Matt. I always thought about, you know, the days we used to do Inside Business. Do you remember that series? AP Moller-Maersk.
Going up to Copenhagen?
Yeah. I'll come with you. I'll do that with you. We get on that, what is it, the Maersk Triple E? The big one. Futures up 13. I'm being told to move. Up a quarter of 1% from New York. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. A new study says that being infected with the Omicron coronavirus variant can strengthen immunity against the earlier Delta strain. The study comes from researchers in South Africa, where Omicron was first detected. The findings suggest that the likelihood of someone infected with Omicron being reinfected by Delta is limited. U.S. health officials are shortening the recommended isolation time for people with COVID who are no longer experiencing symptoms. The new isolation period is 5 days. That's half of what it was. The Centers for Disease Control and Prevention said that after isolation, though, people should still wear a mask for another 5 days when around other people. Goldman Sachs is standing by its office return plan despite surging COVID infection rates in New York. The firm will make vaccination booster shots compulsory. Goldman told its U.S. workforce that anyone entering offices must get a booster by February the 1st if they're eligible for the shot by that date. Kathy Wood's ARK Innovation ETF is missing out on the Christmas spirit in equity markets. The famous technology fund fell 1.7% yesterday. It's down 22% this year, and it's heading for its worst performance since its inception in 2014. Last year, though, ARK was up almost 150%. Zoom and Zillow are amongst the bets that have hurt it the most. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
I think what we've seen during this period of time is that communicating via video is not a fad. That we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The airlines have learned to live with this, and now they're going to have to pay down a lot of debt because they still, the amount of leverage they put on over the last 18 months is still extraordinary. So they really do need to start focused on paying down that debt.
That was Matt Brill, the Senior Portfolio Manager at Invesco. With Matt Miller and Katie Lyons, I'm Jonathan Ferro. Your equity market up 12, advancing 0.25% on the S&P 500. A lift once again in this equity market, all-time highs yesterday, and once again, we're set for more of the same at the opening bell in 1 hour and 12 minutes time. Yields are higher by almost a basis point to 148.42. Euro dollar unchanged at 113.29. Crude positive 1.42% at 76.62. A big change in the last 24 hours in the United States of America. The CDC issuing new guidance for isolation for anyone who has COVID-19. It will be 5 days and not 10. For the airlines, this is what they wanted. Helene Becker, Senior Research Analyst at Cowen, joins us now. Helene, let's start there. The likes of Delta, as you indicate, were calling for this a week or so ago. You could tell something was coming. It came big time. They had to cancel flights. How important is that move from 10 days down to 5? How big a difference would it make?
Yeah, thanks for having me. So yes, I think it's very important. It's cutting that time in half means they can get their crews back in the air quicker, because as this new variant is going through the population here in the U.S., it's obviously affecting everyone, including airline crews, and they don't want to be stuck in hotel rooms either. So getting them back in the air quickly is I think hugely helpful.
So personnel costs are high. I don't know if they're number one or number two. Fuel has to be number 1 or 2 as well, and we're seeing those prices head higher. What do you expect for 2022 in terms of jet fuel?
Yeah, so we're looking at inflationary pressures in 3 or 4 areas. One in jet fuel that you just mentioned. We use the forward curve. So we're right around $2.15, $2.30 right now, depending upon the day of the week, I guess, in the week. That's one big inflationary cost. And then the other big cost, you mentioned labor. So many of the airlines actually have open contracts. American, Delta, and United actually have open pilot contracts. So we're expecting inflationary pressure, maybe not in the captain levels where you've got 15-year employees, but certainly in the starting wage rates, we're expecting that $90 an hour that pilots, the first-year first officers get, to go up. to attract people to the profession. And then we're expecting airport costs to continue to go up because airports are financed with bonds, and those bonds have to be paid regardless. And the revenue for airports generally comes from three sources: parking fees, rental car fees, and which is one source. And then the retail stores, many of them have shut or have reduced hours because of the pandemic and reduced flying. And then the third source is landing fees. And so those with fewer flights, landing fees obviously have come down, so those costs are going up. And then maintenance costs are going up because the aircraft that are in the air still need to go through their regular maintenance cycles. So we're looking at significant inflationary pressure for the industry this year. We're looking at demand being strong. At least we think it will continue to be strong, sort of picking up around mid-February and going through the summer. And then we are expecting kind of 2 years worth of demand, especially in international markets, but not having that capacity to be able to handle the demand. So we're looking at price improvement that should enable the airlines to throw off some free cash flow, especially since many of the airlines deferred delivery of their aircraft from 2022 timeframe to 23-25 timeframe. And so they can start to focus on paying down debt, which we think they need to do. I heard Matt's comments earlier. They absolutely need to improve those balance sheets.
All right, so the costs are going up, balance sheets need to be improved, and we heard yesterday from Matt Brill that these airlines have taken out a lot of debt that they need to pay down. Are they going to be able to do that? Does 2022 look good for beefing it back up?
Yeah, so the way to think about that debt is they've got big cash positions too. They haven't spent all the cash on the balance sheet that they took down. Some of that debt was kind of warehoused that would enable them to go through the pandemic, because nobody expected a straight line up and to the right. Everybody expected it to be choppy and lumpy and with fits and starts. And so they can do three things. One, they can use some of that capital to pay down the debt as it comes due. Two, they're paying back debt as it amortizes, so you have natural debt repayment. And then three, they can use cash to acquire aircraft that they do have coming this year. I mean, not every, I said before, they defer delivery. They defer delivery of a lot of aircraft, but they still have some CapEx to consider. So they can use cash to pay that CapEx, and that effectively reduces debt as well.
Given the kind of different debt levels, given the different balances between international and domestic exposure and capacity, who within your coverage do you think is best positioned going into 2022?
Yeah, so our top pick for, I guess, for legacy airlines or mainline airlines is United. They're 50% exposed to domestic, 50% international, and we think they'll have a pretty good summer. So that would be our top pick. I think when you think about American Airlines, people worry about the balance sheet, but actually they are just amortizing debt. They don't have any significant CapEx this year. They don't have any big debt maturities until 2023. So we think they'll be able to pay down debt. Southwest and Delta both have what I consider to be fortress balance sheets, so we think they'll do well. And Delta has a pretty good situation with their labor, even though pilot contract is open. The rest of the contract, they don't have any other unions, so they pay industry average wages, but they can adjust based on productivity and so on. So they're actually in a pretty good position too. We like Delta as well.
Elaine, wonderful to catch up with you. You know that, as always. Elaine Becker, thank you from Cowen. In the pre-market, some of these airlines broadly positive, mildly positive after being mildly lower yesterday in the equity market here in the United States. Matt, you mentioned something earlier, and I think it's really important. So let's go through the current guidance from the CDC, the new guidance, the fresh guidance from the last 24 hours. Isolation cut from 10 to 5 for people who no longer have symptoms. But then you said something interesting about companies going even further, and I think this is where some tension could be. If you're an airline right now, Delta, this is exactly what they wanted. 10 cut down to 5, let's go. For other companies, Matt, I wonder how many of them will still require a negative test to come into the building, because as you know, and many others know too, we've all got friends who have had COVID-19 and carried on testing positive for weeks and weeks. So the CDC is saying 10 to 5 if you're asymptomatic and you have no symptoms anymore. There'll be companies out there that still require a negative test regardless of the 5-day window the CDC is now recommending.
And countries as well. I mean, keep in mind that, you know, people in this industry are moving between borders and may have to show COVID negative tests as well, especially if they've just tested positive 5 days ago. The CDC issues guidelines for the U.S., but not globally. So it'd be interesting to see what other companies and countries require as well.
So I think we've taken an important step towards treating this differently, a step towards normalcy perhaps. In the near term, though, operationally for some of these businesses, I think there'll be some tension there, at least in the near term. From New York City, for our audience worldwide, heard on radio and seen on TV with Katie Lyons and Matt Miller, I'm Jonathan Ferro. TK and Lisa back next week. This is Bloomberg Surveillance.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
69 record highs of the year so far on the S&P 500 could well become 70. Your equity market, we add some more weight to it. Up 12, adding 0.25% to the S&P 500. Yields going nowhere. 147.90. Euro dollar going nowhere. 113.28. Unchanged. Crude positive, 1.28%, up to 76.55. And Matt, you said it, that CDC decision, for some people at least, including you, and for me to some degree, a bullish call.
Yeah, absolutely, because of the problems businesses have had with employees being out for a full 10 days, at least 10 days after testing positive. They've had to shut down services. Some companies have had to shut down production. Some companies have shut down retail outlets. If they can reduce that to 5 days, and the CDC now says that you can as long as you're asymptomatic, that obviously opens up a chance for them to do more business and raise revenue, profit as well.
And maybe to some extent makes it easier to forecast this economy into 22. Let's do that right now with John Riding, the Chief Economic Advisor of Breen Capital and a good friend of this program for a long, long time. John, it's good to see you, buddy, as always. Let's start with a call for next year, John. What are you focused on?
Well, I think the main focus is the inflation story. And this was a story that as early as April of last year, we warned that we were going to have an inflation event, not a disinflation or deflation event, because it would negatively, it being the virus and the government lockdown measures, would negatively hit the supply side. Now, the supply chains have been hit harder, more prolonged than I think that we imagine. And on the other side, we were going to get massive demand stimulus that was monetary financed, and we've certainly had that. And as a result, the combination has been a far more elevated inflation rate than anyone expected, almost 7%, may well be 7% when the December data come in. So the question is, how much does that inflation rate moderate, and what is the policy response? Because I just don't believe that inflation is going to wind itself down to 2% without little action from the Fed. I think inflation expectations are getting embedded. Your previous guest talking about all those pressures on the airline industry was just an example of the cost pressures that companies are able to pass along in this environment. So I think the inflation story is the first one. I think the inflation rate is going to be close to 4%. And the Fed's going to end up taking more steps, as it signaled at the last meeting with its dot plot, than people have been expecting.
A couple of things there, John, then. The scale of deceleration on headline inflation, you're looking for 7 potentially to close out the year into next year, and the policy response that would shape that move lower. John, let's build on that. The expectation now for many people is 3 hikes next year. Does that do anything, John? Does that achieve anything?
Well, I think it starts off as a signal. And I think the key thing was for the Fed to recognize the problem. I don't think the Fed fully recognized the problem at Chair Powell's last press conference, but I think it went some way to recognizing the problem by getting rid of the transitory language, putting in 3 hikes that were supported by 13 members of the committee, as opposed to the 1 hike that was at the in the last dot plot back in September, which was basically a split decision with as many people looking for 1 hike as looking for no move at all. So it is an important signal. And I think the really good thing would be if that move came in March. The asset wind down of the asset purchases ends in mid-March. The next decision day, I think, is March 16th. So if the Fed were to raise rates on March 16th, it would be a signal. And then the next signal will be start letting the balance sheet run off, and perhaps do that as soon as June of next year. Will that be enough? Probably not. But it is important that the Fed recognizes the problem and starts to take steps. And then that makes companies begin to think, should price increases, which I fear is becoming the case, not be part of our process for making profits? Because we're in an environment right now where we've got cost pressures, but companies are raising prices by even more than their costs are going up, perhaps using the cover of costs, and widening profit margins. And that's relatively unusual. That's certainly different from the inflation environment that we had in the 1970s. So I think those signals are very important to start reframing the decision-making process. But no, by itself, I think there's going to be more rate hikes into 2023. and more, I think, than are being signaled by the dot plot. But on the other side, the economy is still going to be rolling along because there's so many supply constraints. So higher rates aren't going to hurt the economy. We've got so much excess demand in the system. Taking some demand out isn't going to slow growth. It isn't going to create any slack in the labor market. There's just simply plenty of jobs out there. And all of this COVID protocols are making it harder and harder to fill those positions.
So is what you're saying essentially, John, that the Fed is likely going to have to move more aggressively, but it's not going to amount to a policy mistake of some kind?
The policy mistake's been made, and the policy mistake was keeping the emergency measures in place for too long. There was no need to have continued purchasing at $120 billion a month almost through to the end of this year. They only started that wind down adjustment in November. So that was one policy mistake. The Fed could have signaled that inflation wasn't going to be transitory, or they weren't going to let it be anything other than transitory by recognizing the problem. But I think there was some mischaracterization of the inflation problem. A lot of focus on reopening, a lot of focus on a handful of items, even as all the data showed that it was broadening out, and the inflation pressures have broadened out. And you can't talk down this inflation problem. You know, a credible Fed has to talk against the inflation problem, take action against the inflation problem.
Well, John, Matt brought up the great point earlier around the timing of Powell changing his messaging, retiring the word transitory, and the president renominating him for a second term at the Federal Reserve. The president still, though, has several more nominations to make, seats that need to be filled. Do you think who sits in them could shift the balance of policy going forward?
It could, and it could shift the balance to the detriment of the outlook, and it could shift the balance to the detriment of this administration. There's this false belief that somehow having dovish members of the committee, by dovish I mean less inclined to raise interest rates or to be more focused on things other than inflation, somehow helps the administration. And that's just a false choice. What we need are people who have some experience with inflation, some strong academic background on the inflation front. We need strong people on financial regulation, because the other problem is going to be with, especially the chair of the vice chair for financial supervision, Open, is going to be the potential impact on the markets of unwinding all this accommodation, which has been in place too long. So yes, good choices could certainly help this and push the Fed along. Bad choices could make the inflation problem worse, and that will hurt the administration. It will not help the administration, nor will it help the economic outlook.
I think, you know, you bring up an interesting point, an important point, John, with regards to experience. And you're obviously a sprightly young man on the football pitch, but you were around during the 1980s when we saw real inflation. You were advising the Bank of England. You were advising the Federal Reserve Bank of New York. What can the Fed do other than simply raise rates in order to fight inflation?
It's about signaling, and it's about saying what your priorities are, as well as taking action. And an important signal will be starting to wind down this balance sheet. Now, my preferred outcome, which is not going to happen, is the Fed actually starts selling assets. The Fed's not going to do that, but they could wind down somewhere between $1 trillion and $1.5 trillion simply by stopping reinvesting and putting relatively high caps to that runoff each month, and that will be an important signal. But it really is about the signaling and to back up the rate actions, so that we've heard what are the instruments of policy the Fed has: asset purchases, rates, and forward guidance. So put all of those into action. And if the Fed were to talk about asset sales as opposed to asset runoff, that would be a real tiny move. But I think taking action on the balance sheet in June, which I think could happen, would be a strong signal. But once the inflation gene is out of the bottle, and it's getting out of the bottle, it just doesn't easily go back in again to For those of you, John, who may have seen Christmas pantomimes when you were a kid, that getting the genie back in the bottle, very difficult trick.
I used to hate them, John. He's behind you. That reference is lost on everyone in America. John, just quickly, you said something there so important, and I think we can sort of think about this without the noise of the market on a week like this. You said they should sell assets. Can you imagine, John, what would happen if they sold assets? Like, John, what do you think would happen in financial markets if they said, we're not just going to end reinvestment, we're going to sell?
Well, I think that especially if they were to say, let's sell the mortgage assets because we really want a treasury-only portfolio, or sell and partially reinvest in treasuries. That would be more like a capital market decision. But I think the key thing is telling the markets in advance, guiding the markets to that. But what would happen? It would tighten financial conditions. And the Fed's trying to sort of pull off this impossible scenario of tightening policy without tightening financial conditions.
Yeah.
And that's not possible. It's like trying to make an omelet without breaking eggs, to use the well-worn analogy. Financial conditions will have to be tightened, and selling would tighten them a lot more. But look, it's not going to happen. I think one thing we can count on, the Fed's not going to do. The best we can hope for is an early end to reinvestments. And if the Fed were to hike rates in March and to allow assets to start to run off in May or June, as I think some on the FOMC want to do so. Governor Waller has been very clear on wanting to allow assets to run off fairly quickly after the Fed starts hiking rates. I think that would be a good step in the right direction to tackling the inflation problem. But let's be clear, even under the best policy for fighting inflation, we're still going to have an elevated inflation rate in 2023 and possibly even into 2024.
John, just quickly, Tom Keane writes in, ask John on Preston North End and Stoke on January 3rd. Anything we should know,
well,
John?
Let's hope. Let's hope the game goes ahead. I mean, the key thing is that all the games that I cared about were cancelled on Boxing Day, which is December 26th. Those of you who, like John and I, don't have
your beloved Preston. John Riding, a Merry Christmas to you, sir. It's good to catch up. John Riding there of Bring Capital from New York City. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. It's a record that many thought we'd never see. Global coronavirus cases set an all-time daily high on Monday, more than 1.4 million infections. That happened a year after vaccines started rolling out and 2 years after the virus first emerged. The 7-day rolling average of cases was 841,000. That's up 49% from just a month ago when the Omicron strain was first detected. The UK government has ruled out tighter coronavirus restrictions before the new year. That's despite the rapid spread of the Omicron variant. Health Secretary Sajid Javid urged people to be careful, especially at New Year's celebrations, and he said the government won't hesitate to act if necessary. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But Also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Happy holidays from your Bloomberg family.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Job gains are significant, only held back by the shortage of labor. Also, wage gains are noticeable. So all in all, I think the wealth and income situation of households will remain favorable enough for households to stomach the higher prices.
Holger Schmieding, chief economist at Berenberg, talking about household wealth. Of course, household wealth, we're talking about people who own homes because, Matt, you kind of have to have a lot of wealth to buy a home right now. The market continues to be hot, and that is definitely true in the New York tri-state area.
Yeah, definitely. Well, I think across the country, the market has been hot. Prices have just gone up, and away. And the question that I have is, how can your average American, yesterday we were showing clips of Kamala Harris talking about real Americans, working people. How can they afford to buy a home in this market? It's just unbelievably expensive. And I guess the plus is you've got low mortgage rates. That's helping people get into the market. But still, the kind of increases that we've seen, 20%, 30% price increases year over year, just make me wonder about the affordability portion of this.
Yeah, a lot of people definitely getting priced out, but rents are going up too. Something else to consider. That is definitely true here in New York City. Let's talk more about this with Bess Friedman, CEO of Brown Harris Stevens. Bess, as you look at this market, obviously it has been incredibly hot. We've seen a record quarter of sales here in New York City. Do you expect that can continue going into the new year?
I think we may have a little bit of a slowdown, as Matt mentioned. Rates are probably going up. The Fed announced that rates will go up maybe 2 to 3 times next year. So we may see a little bit of a slowdown. Also, supply is diminished because demand is so heightened. And remember, 2021 has been a phenomenal year in housing. And much of that is attributable to the fact that the vaccine came out a year ago. And so people are feeling very comfortable. They're returning to cities. And they really believe in the home buying process. We're now even seeing millennials buy, which, you know, in the past they were considered kind of the unburdened group that wanted experiences versus commitment. And now millennials are buying. Also, the fastest growing segment of our market is the Hispanic community, which is fantastic. Borders are open, bonuses are really good. So I think we're going to continue to see spending, but it may slow down simply because supply is shrinking a bit.
Well, and will that drive more people into the rental market as well? Matt was kind of alluding to people getting priced out of home ownership just because prices have gone up so more, but you aren't necessarily met with an easier picture when it comes to the rentals market.
No, the rental market, I mean, who knew? I mean, 2 years ago, the rental market was a whole different scenario. And now it's, you know, there's no sort of advantages in renting. I mean, you're not getting any months free. Occupancy is very tight right now. And so I think people are feeling more inspired by the fact that they want a full-on commitment. They want to make a home their own. I've had many friends who rented in New York City for a long time and decided to pull out and purchase. They wanted to invest in something that was their own, where they could raise their kids, that they could make it special to their needs. And I think rentals are great. There's a lot of people that are moving here because Microsoft is opening an office. Google's got another office, Disney. So there's a lot of young people moving here, and rental provides a sort of temporary housing. But for the long term, I think people really feel more comfortable buying, investing. I mean, it's a sacred investment. It's such an emotional commodity. And now that the, you know, COVID, listen, that's always going to be something that we have to contend with. But, you know, fear is probably the most unreasoning of emotions. And we saw what that did in the beginning of the pandemic.
Well, and it's great to have a home, you know, not just a house, but a home, of course. That's what people want, part of the American dream. I was watching Being the Ricardos last night, and that's what I Love Lucy wanted to have too. In terms of the taxes, Bess, that's a real problem in the tri-state area, in California as well, in some markets. And whether or not you get a SALT deduction cap raised now is kind of a crapshoot. But is there any other way that that's going to change? I mean, why are the taxes so high around New York and New Jersey? Why?
I mean, this is a real challenge. We've had irresponsible legislation in Albany, and there's been this sort of mindset of wanting to gain Twitter followers versus, you know, responsible tax policy. And I think we have a new city council coming in January, which will be helpful because they determine the budget for New York. We have a new mayor, which is fantastic, who wants to work together with, you know, teachers, with creating affordable housing, with the business community, which is something we desperately need. And we have to think about things like the 421A. We need an extension of that. And we're hoping that Governor Hochul will include that in her budget. So there's so many different things. We're tired of the divisiveness. We're tired of the demonization of the rich and tax the rich and driving people out of New York. We want people to come back to New York. We want tourism. We're pro-business. So I think you have a new mindset coming in, Matt. I think taxes have to be treated with sort of an economic mindset, and we don't want to punish people just because they're rich. Change tax code. Don't demonize the wealthy. And I think that's sort of, you know, the AOC mindset of, you know, tax the rich, wearing that to the Met Gala was just divisive and hurts everybody. We have to be a little bit more responsible, and I think we are going to do that in 2022. I hope. For your sake, Matt.
This is personal for Matt Miller.
Well, I also, you know, a lot of people are divisive in this day and age, and I agree, it's not a great thing. But being the term rich, right? It's also relative. I mean, if you're raising a family of 4 in the New York suburban area and making $250,000 a year, it's still a bit of a struggle.
It is. It's very much a struggle. And look, there's a lot of people who are wealthy, who help, who do so many things, who are philanthropic, who do things to help people, who help to build affordable housing, who want to improve our environment. And so I don't think throwing labels on people just because they're wealthy is helpful. I think we have to have a new sort of way of looking at things and work together as a community to make New York stronger and not put labels on people. I think slogan politics, we've learned, sucks. And we have to create a new environment. We're all sick of it. we kind of want to work together. And most people are in this sort of moderate tent of doing the right thing. And I think hopefully 22 is going to be this sort of new day for all of us.
Yeah, I think we would all like to have a little bit less political partisanship and divisiveness. Thank you so much to Bess Friedman, the CEO of Brown Harris Stevens. Matt, I know you're feeling these taxes as you prepare for a move to New York in what, a couple weeks?
Yeah, less than a week from Friday. So that's, like 10 days from now. I'm excited about it. The taxes are what they are, and at least I'm looking at fantastic services. On another note, did you see Being the Ricardos? Have you seen this new Amazon movie with Javier Bardem and Nicole Kidman?
I haven't, but I actually saw them filming it in New York a few months ago. It was kind of cool.
I thought it was really good. I watched it last night. I'm not sure if you have ever seen I Love Lucy, but when I was a little kid, the reruns were very popular.
I've seen it. I remember watching an episode about Vegemite. Anyway, back to the markets. We were looking at another record high for the S&P come the opening bell in just about 35 minutes time. 47.91 is where we sit. Steve Cheverone of Federated Global Investments will have thoughts on that in a bit. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
staring down the barrel of another all-time high. From New York City this morning, good morning, good morning. Your equity market up 7, advancing almost 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. The road to normalcy takes a detour.
The Omicron variant, Omicron.
It was clearly a curveball into the end of the year.
Here we are at the end of 2021, still dealing with a virus named after 2019.
It just feels like deja vu.
The bigger question is, what regime are we going into next year?
People can't go to work if they have the virus.
What is the economic implication of Omicron?
It's going to have an economic impact whether or not it's deadly.
More inflation, not less inflation.
It is still much more transmissible.
I'd be cautious.
It's like more red flags than most of my ex-boyfriends.
There's going to be a bit of a roller coaster ride.
I'm laughing at that last comment before the last comment. Joining us now is UBS's Stuart Kaiser and Troy Gajewski of FS Investments. Troy, let's get to this market. Futures rolling over just a little bit, but record high after record high. Even with this disruption, I feel like I'm having a conversation we had 12 months ago. Are we taking steps towards getting back to normal?
Yeah, I mean, fortunately we are. Obviously, there has been a detour, as your other guests stated in previous interviews. You know, we could have up to a 50% GDP hit next year because of Omicron. We also could have slightly higher inflation. You know, that being said, when we look through the data, we still think we're going to end up somewhere between 5 and 8% nominal GDP growth, with somewhere between 2 and 4% real. And, you know, we don't like to be overconfident in our forecast now, particularly around epidemiological studies. But so far, we do know the data shows that it's more transmissible and less virulent. And, you know, you talked about the headline earlier today about how we're going to shorten the quarantine period from 10 days to 5 days, which is very important. But the flip side is we're finally getting data that shows Omicron does provide perhaps some protection of Delta, which was really an unfocused level of study up until recently. And that's very critical, right? Because if Omicron does not give you some degree of immunity to Delta, then you're purely relying upon vaccines and herd immunity from cases.
That's why, Stu, for many people, they believe, put all this together, we're taking a step towards getting back to normal, and maybe a big step as well. Do you agree?
Yeah, I do, Jonathan. Good morning. Thanks for having me on again. You know, I would say the market's treating this as an endemic, whereas a lot of the headlines, I think, are still treating it as a pandemic. So I think the market is just starting to digest the fact that we're going to get, you know, new variants over time, but you need to sort of deal with those in a risk-managed way that balances sort of health risks with economic risks. And I think that's one of the reasons that the quarantine period was shortened up a little bit, you know, because we do have a high vaccination rate, and the disruption to the economy was becoming so stark that, you know, they had to make some changes. So I think the reason the markets are rallying is because, you know, I think they've sort of moved into endemic phase from pandemic phase, and I think that's probably a positive for the markets and for the economy.
It's been positive in the last 24 hours, that's for sure. The CDC cutting that isolation guidance from 10 to 5 days, helping Americans get back to work. This comes as Goldman stands by its return to office plans, mandating booster shots by February 1st for anyone entering its offices. For more, I want to bring in Bloomberg's Sonali Basak. Sonali, are we going to get back to the office this time? It feels like the conversation we had 12 months ago.
Yeah, no kidding. Everything has changed. It's clear that the return to normalcy will come with new rules. The Goldman mandate is the most aggressive we see among the big banks. But remember, they were also the first to bring people back into the office. Now, it also begs to question, John, how many people will require boosters into February. We saw Jefferies make a similar move, but it was only, remember, mid-December that we saw JP Morgan create a vaccine requirement at all for its big Manhattan towers. So the rules are different still among all the banks, but it's clear that to get people back into the office, they're going to make demands of their employees to make sure everyone stays safe.
Sonali, just a follow-up question, and I wonder if you've got any reporting on this. Matt and I were talking about this morning, that there could be some tension between the CDC guidance and the rules within certain companies. The CDC now saying, if you don't have symptoms, it's been 5 days, great, you can return to what you were doing. Sonali, I wonder if some of the companies still require a negative test, because if we know you might not have the symptoms, but you might still test positive.
Yeah, it's a good question. They're doing everything they can. Remember, when somebody comes into the office and then the rest of your staff also gets sick, that's also very disruptive to a business. So look at Goldman, 2 tests a week now they're going to be requiring. But to your point, there will be divergences across Wall Street, because at the end of the day, what they will do is stick by the CDC guidelines to the best of their ability, but it will create some tensions.
Shonali, thank you. As always, Shonali Basak on the big banks on Wall Street and some of their plans as we cut that window from 10 days to 5. Can we get back to work? And what does this whole conversation mean for the outlook for inflation as well? We caught it with Flowbank's Esty Twegg. Take a listen to what she had to say.
China has had a zero COVID policy, and if their vaccine isn't as efficient, it means more closures, which means supply chain disruptions can't improve as quickly as we would have hoped, and inflation could stay higher for even longer. And I think that's probably the biggest concern.
Troy, let's get to you on this, because I think it's really important. We started by having a conversation on the United States, the guidance from the CDC, the disruptions we might get here, the minimization of those disruptions here in America. In China, it's a different conversation, isn't it? And I wonder what that means for your outlook.
Yeah, so again, I think she summed it up very well in that if you look at China, they've had this zero tolerance policy, which is extremely aggressive, and hopefully it works out for them, although it's unlikely. And when you think of inflationary pressures caused by Omicron, not only are they tied to a slower return to work, as you've discussed, but they're also tied to more elongated supply chain issues. And, you know, in the short term, markets are more focused on China's ability to re-stimulate their economy. That's really critical for asset prices, particularly in basic materials and other, sectors such as energy. However, when you think of inflationary pressures to the majority of the goods producing economy, that's really going to be a function of how fast these supply chain woes can ease. China's zero tolerance policy clearly does not help.
Stuart, do you expect those supply chain issues to ease quickly through next year? Is this going to be a long slog through 22?
Yeah, I don't know if I'd put it quickly. I do think we do expect to see steady improvement, and I think we've already started to see steady improvement. I think seaboard freight has already started to improve. So, we do expect it to improve as you go throughout the year. I think it's going to be slow. You're probably not going to be confident that inflation has peaked until mid to late 2Q, and even then, based on the Omicron disruptions, that could extend that out a bit. So, we do expect kind of a slow, steady improvement. Clearly, the new variants kind of add some risk to higher and longer for inflation. And, this is going to be an issue. I think inflation is just an issue in general, in the sense that we have, headline CPI peaking in, sometime in 1Q at around 7.25%. We don't have core peaking until kind of late 1Q into early 2Q around 6.5%. And again, I think you're going to need a couple of months of data before you're confident that that's actually happened. So, it's a topic that's going to be with us for a while, and it's certainly going to put pressure on the Fed. And I think that's why we've seen the Fed pivot so quickly the last month or two.
Stu, what does it mean for your market call at the moment?
I think it's an additional risk in the system. I think a lot of this risk is already priced, at least in the vol market. If you look at the VIX curve, the sort of 4, 5, 6, 7 month VIX futures are at the same level today they were 12 months ago. And that's pretty surprising given the amount of progress we've seen, in the economy over that time. So, from my perspective, the market's pricing a fair amount of risk kind of 3 to 6 months out. Skew is at extremely high levels. So I think that risk is, I don't know about adequately priced, but I do think it's fairly fully priced right now. And my view is that kind of risk pricing is going to remain very, very sticky for all the reasons we've mentioned.
Troy, can I come to you on that as well? Just how important is the inflation call with regards to your market call for next year?
Well, yeah. So if you imagine a different scenario where we didn't have such tremendous inflationary pressures, then that would not have driven the Fed to obviously taper faster and then potentially hike 3 or even more times next year. So it's very critical. And when you think of the short term, again, we're really being powered ahead by all the abundant liquidity that's been in markets plus seasonality. But now the die is cast, right? Taper is going to be completed by the end of March. Money supply growth is going to go slower soon thereafter. And the Fed's going to be hiking 3 or plus more times. So that gives us more confidence that the back half of next year is going to be much choppier, and we're more likely going to see some degree of multiple compression. So without such extreme inflationary pressures, the Fed wouldn't have been forced to pivot as fast. So it's very, very critical for market outcomes next year.
Troy, just in terms of tightening, I want to build on that with you through the next hour or so.
Yeah.
But whilst we have the time now, is it the tapering that's tightening, the prospect of rate hikes that's tightening? Is it the balance sheet reduction in the back half of next year that we could get that would be tightening, that would lead to multiple compression? I'm trying to work out what it is when I look at negative real interest rates, deeply negative, and it could be that way for a long, long time. Anything the Fed has got planned, is it actually tightening?
It's the relative change in money supply growth that tends to be important with a lag about 3 to 4 months out going forward. So if you think of history, and again, you have to be careful when you draw too close parallels, but you think of a period like 2018, where you did see some degree of balance sheet runoff and additional rate hikes, there you were clearly tightening, right, because of the balance sheet runoff. Next year, the marginal change in money supply will decrease, which is partially tightening. That in turn will lead to a slower money supply growth, which will lead to less abundant liquidity and could lead to some degree of multiple compression. It's just much more likely that we have multiple compression as opposed to expansion. So all of these taken together mean less buoyant markets and more likely that we have a volatile back half of next year.
Stuart, can I get your view on that too? Because we often reference this back end of 2018, the back end of 2018 when we had balance sheet reduction and a Fed that many people thought was being too aggressive. Real rates were positive 1% plus then. They are negative 1% plus now. Does that make a difference?
Yeah, I think the starting point definitely makes a difference, but it's the rate of change that's more important in our view. And we do expect a reasonably large backup in real yields, during 2022. So we do think that is an issue. I think the timing question is really the big open question. Does the market start to pull back, late in 2022 as this tightening happens, or, early next year when you have inflation at peak levels and the outlook is for tightening later in the year and for a kind of sequential slowing in GDP and earnings growth, does the market start to react to that then? So I actually think that the first quarter and the first half of next year, has a lot of potholes baked into it as well, because the market's forward-looking. I don't think the market's going to wait for the Fed to raise rates to react to it. So I think that the timing aspect is obviously the hardest to pin down, and in my view, I think early next year has more risk baked into it than I think most market participants are willing to price right now.
Stuart Kaiser, Troy Gajewski, sticking with us. Coming up on the program, President Biden pledging his support for state-led efforts to combat the COVID surge.
We're now able to purchase 500 million at-home rapid tests to be sent to the American people for free when they request it. But we have to do more. We have to do better, and we will.
That conversation coming up next from New York. This is Bloomberg.
When your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
in some ways, he's just right back where he started when he first was inaugurated, right? Dealing with a lot of holiday surging on COVID, and the vast majority of Americans were not yet vaccinated. And they were told, look, go get vaccinated and things will get back to normal, or at least as close to normal as possible. And the vast majority of Americans did get vaccinated. Here we are a year later, and it just feels like deja vu. And I think that's just a really big problem for the Biden administration.
Global virus cases hitting a daily record 2 years after the emergence of COVID. President Biden saying the solution lies in state-led efforts, telling governors the following: there is no federal solution. This gets solved at the state level. If you need something, say something, and we're going to have your back in any way we can. For more, let's bring in Bloomberg's Joe Matthew. He joins us now from D.C. And Joe, as you know, often in politics and political coverage, the context doesn't matter, the broader conversation doesn't matter. It's that one line: there is no federal solution, that everybody has picked up on. Joe, how's that playing out down in Washington?
Yeah, not a shock to see people jump on these words, certainly Republicans, as we remember where we were over a year ago, Jonathan, in the Trump administration, when governors in many cases were begging for help from the feds, and in some cases finding themselves in direct competition with the then Trump White House, even being outbid for critical supplies like ventilators. This is a bit of a different scenario here. The GOP, though, did jump on this immediately. They tweeted the statement and retweeted comments from Joe Biden from over a year ago when he pledged, "I'm going to shut down the virus." We should note, though, that he was in a meeting with the Governors Association and was specifically responding to a remark from Asa Hutchinson, the Republican governor of Arkansas, who was urging the federal government to be careful to not compete with states in acquiring more rapid tests. Jonathan, we've been talking a lot about short supplies of tests, but Hutchinson also went on to compliment the Biden administration and the way the White House was coordinating in test manufacturing with states and so forth. So this was a brief moment. It appeared to be an ad-lib remark, and it did not, Jonathan, appear to signal any shift, an actual formal shift in White House strategy here.
These things happen sometimes, and no doubt they'll happen again and again and again. I have some good news for the administration. Joe, I have some good news for the Democrats. The midterms aren't today. They're next year. And Joe, I just wonder how they can turn this around in the next 12 months.
Well, bring the caseloads down. You know, I'm not sure that it's fair to compare where we are right now with where we were a year ago. Although the numbers are staggering, and we knew that we were going into a difficult season here. The seasonality of COVID, of course, is its own story, along with Omicron. But once these tests are in the pipeline next week, and if that does result in more vaccinations, this White House could find itself telling a different story by spring. I would just remind everyone, though, about this Supreme Court case that will bring this state versus Fed issue to the fore at the beginning of January when we come back from the New Year's break here. The concern about mandating private employers to have vaccinations for those with workforces of 100 or more. This is going to get an up or down, and will be another brick in the wall in this Fed versus state conversation, Jonathan.
Joe, thank you, buddy. As always, Joe Matthew.
Pleasure.
Sound on Bloomberg Radio a little bit later this evening, 5 p.m. Eastern. Don't miss that. Caught up with Jim Bianco recently of Bianco Research on the Federal Reserve and this tough decision between supporting markets and doing something about inflation. Take a listen.
Several political polls now have inflation ahead of COVID as the #1 issue in the country. The Fed's in a tough spot because on the one hand, they want to appease financial markets, but on the other hand, you've got the public that's upset about inflation. So which way are they going to go? Are they going to appease markets, or are they going to appease the public? It seems like they can't do both at the same time.
In many ways, Jim is stating the obvious here, and John Reining of Breen Capital earlier on this morning brought the same thing up. And Stuart Kaiser, Troy Gayeski, I think it's a really important question. Troy, to do anything about this, they have to tighten financial conditions. And right now, financial conditions are really loose. Can you achieve what they're trying to achieve on the inflation front without causing any pain in financial markets, Troy?
Well, I 100% agree with Jim in that, prior to the COVID peak, arguably the biggest reason Biden's poll numbers were going down is that we've seen the highest levels of inflation in 30, 40 years. So that is much more of a Main Street concern. And at the end of the day, the Fed can't run a hot economy with tight unemployment and 7% inflation and expect there to be happy people out there, right? So, at this stage of the game, they're going to have to risk some pain in markets in order to tame inflation, because then you could go into the midterms with caseloads going down, inflation dropping, and at least articulate a positive vision going forward. If we continue to print, 6, 7, 8% CPI numbers throughout Q2 and Q3 of next year, I mean, the public angst over that will escalate dramatically. So it's tough. It's a tough situation for the Fed. It's never easy, but we do think they're doing the right thing, even though they are a bit late to tighten policy right now.
Stuart Kaiser, can you imagine a situation? Can you envision this? Inflation coming down because the Federal Reserve is doing something about it, and markets remain supportive and financial conditions remain loose. Can both exist?
Yeah, I think they can both exist. I mean, I think the big open question is, does interest rate policy impact supply chains? And, you know, there's certainly a chance here that you're raising rates and the issues that are actually driving inflation are not addressed by higher rates. So that would be, I think, the very negative outcome. I think the more positive outcome that you've described is we get a very modest amount of tightening. Supply chains and other things reopen, you know, independent of what's going on with Fed policy. And then that sort of allows equity markets to continue to perform pretty well because you're sort of tightening financial conditions from a very, very loose level. And then you get kind of a response in the supply chain at large that helps markets move higher. So I think it's possible. You know, I think the Fed, you know, kind of let it go a little late, and now they're in a position where maybe they need to thread the needle a little bit. But I do think there is a viable exit strategy there. But there's a lot of uncertainty around it because it relies on things that, you know, frankly, I don't think they have a whole lot of influence on.
Well, let me introduce another scenario then. It's that time of year we can do this. Troy, let's imagine a situation where, because real interest rates are so deeply negative that even if they start hiking, they don't actually do anything about what's happening, that financial conditions remain loose, that it's not until they have to do a whole lot more beyond 22 and into 23 before financial conditions start to tighten. Is that something that could play out here through next year?
Yeah, that's certainly possible, right? I mean, I think if you think of the probability distribution, right, there's almost no probability of further multiple expansion. And there's a reasonable probability of multiple compression to some extent, right? They can thread a needle in that financial conditions can tighten marginally, but you could still have equities be slightly positive, right? Because earnings are going to grow somewhere between, let's call it 6 and maybe upwards of 12%, depending upon where nominal GDP shakes out. So there, you know, it's all marginal, right? We're not talking about an apocalypse now at the end of 2022. We're just talking about the fact that it's unlikely that you're going to see the material degree of gains that we've enjoyed the last 2 years in broader markets. And it's really time to think about at least modestly diversifying into alternative products that can generate a very attractive return, but not have as much downside risk or volatility.
Troy, I'm surprised it took 22 minutes to get to the pitch. I'm going to give you more time on that.
Hey, man,
yeah. It's Christmas. I'll give you that gift in about 8 minutes' time. Sit tight. Troy Gayeski, Stuart Kaiser, sticking with us. Your equity market coming in just a little bit. Still positive. Up 5 on the S&P, advanced at around about 1/10%. Coming up, the morning calls, and then later, the S&P 500 on track for its 70th record high in 2021 in the final week of trading for this year. That conversation just around the corner from New York City. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Tuesday morning, no drama. Good morning to you all. Equity futures look like this, up about 0.1% on the S&P, advancing 5 or so points. On a Russell, we're down about 3, negative 0.1% down on the Nasdaq 100. What a run it's been recently, up about 36, advancing there 0.2%. On the S&P on the year so far, up around about 28%, 27.5% year to date. One single name that beats that, here's one at least, Apple, up around about 35% year to date. 182.86 is the line of the sand in the pre-market right now. 180.10, just a little softer, down 0.1%. Why does 182.86 matter? Doesn't matter so much to me, it matters to some people. That's the line in the sand to achieve a $3 trillion market cap. That's one to watch at the opening bell. Here are some of the morning calls this morning. We begin first up with Argus raising its price target on Tesla to 13.13. With a buy rating on a stock, the analyst expecting third quarter operating results to exceed expectations with record deliveries. Argus raising its Hilton price target to 178, seeing increased room demand amid the continued rollout of vaccines. And finally, Benchmark initiating Tencent Music with a hold. The analyst positive on growth opportunities, but expecting a negative impact from regulatory changes. Your opening bell's up next with a 70th record high in sight.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Live live from New York City this morning. Good morning to you all. Around about 20 seconds going into the opening bout. A shape of things as follows. Futures up 5, up around about 0.1%, down 3 on a Russell, negative a tenth there on the Nasdaq 100. What a run we've had. Up around 40 points right now, up 0.2%. There's the opening bout and a pretty tame whoop to go with it. Switch up the board and get to the bond market. It's that kind of week, isn't it? Katie and I have talked about it all through the week. Just close the market. Come on. For goodness sake. Yields in 2 basis points, 145.33 on 10s. Crude higher by 0.9% to 76.29, and euro dollar negative 0.2% at around about 113. Euro dollar not doing much at all. A slightly weaker euro in a mix. The S&P 500, another record in sight, up around about 0.1% on the S&P. Consumer discretionary top of the pile, up 1/3% there. The financials down around about 0.1%. In the bond market, yields coming in a couple of basis points, as I say, to in and around 146. So we've got the S&P on track to post another record high. It's 70th for the year. Victoria Green of G Squared telling investors not to underestimate stocks. Take a listen.
We like this. We'd love to see the Santa Claus rally continue. And I think the ability of equity markets to climb the wall of worry should not be underestimated.
Back with us, Stuart Kaiser, Troy Gayeski. Guys, this is what I want to do in the next 10 minutes. Let's start with your big calls for 22. And then a little bit later in the segment, I want to come back and talk about the big lessons from 21. The big calls for 22. Stuart Kaiser, first to you.
Look, Jonathan, our outlook is basically S&P kind of peaks during 2Q around 5,000, and then you kind of weaken into the second half of next year. I think, frankly, the biggest calls I think we have from a macro perspective would be, a very strong deceleration in inflation, once you kind of peak late in 2Q. And, that drop in inflation and inflation break-evens allows real yields to rise considerably. So I think, those are probably from a macro perspective, the two biggest kind of moving points to keep an eye on. As I mentioned earlier, I do think the market kind of post 4Q earnings as we get into February is probably underestimating the risks at that point, because you will have inflation peaking. You will have a sequential slowing in growth kind of in the 12-month outlook. And I think markets are going to probably struggle a little bit to deal with those two things. So I think those are probably the biggest moving points to highlight from our perspective.
Troy Gayeski.
Our biggest points would be markets continue to be strong into early next year due to abundant liquidity and continued seasonality, a strong January effect. And as we move into late Q1, early Q2, that's where the chop starts to show up, and the modest tightening of monetary policy dramatically reduces the reward to risk profile of broader equity markets. That's A. B, credit is still firmly bid. Due to the very strong nominal GDP growth and reasonably strong real GDP growth, the delinquencies stay extremely low. So we don't expect material spread widening. And the back end of the curve, we end up with a very sort of shallow bear flattener where the back end does back up a bit, but somewhere around 25 basis points or so, versus a 75 basis point increase at the front end by the end of the year. And the main reason for that, John, other than the usual suspects of negative rates overseas and, a total dearth of AAA long duration assets, is that we have over 1.5 trillion of capital sitting in the Fed's reverse repo, which has grown from April, that's just waiting for a home to go out on the curve at higher rates. And so, it's highly unlikely that we get a material increase